Cameras are on.
Great. Good morning. Good morning. Good morning. Ah, that's more like it. Thank you.
Good morning, John.
Welcome to the New York City Retirement Systems, Common Investment Meeting for December 17th, 2019. We're going to start by calling the rolls for each board. And let's start with Fire. Patrick Dunn.
Good morning, John.
Good morning.
For Mayor de Blasio,
Cynthia Collins, designee for Mayor Bill de Blasio.
for Comptroller Scott Stringer,
John Dorsett, designee for Control Scott Stringer.
for Commissioner Jacques Giha, Finance,
Phil Dukes for Commissioner Jacques Giha.
for the UFA, Mr. Gerard Fitzgerald,
Leroy McGinnis with Gerard's proxy.
Mr. Leroy McGinnis,
Here.
Mr. Edward Brown,
Vin Speciale, proxy for Eddie Brown.
Mr. John Kelly,
Pete DeVita, holding proxy for John Kelly.
Mr. Peter DeVita,
Here.
He'll be here.
for the UFOA, Mr. Jack Kelty,
Here.
Mr. Liam Guilfoyle,
Here.
Mr. Paul Mannix,
Here.
and for Fire Commissioner Daniel Nigro.
Terrell Brown for Fire Commissioner Dan Nigro.
We have a quorum.
Thank you, Pat. Next, Police, Kevin Holleran.
Good morning. Representing the PBA.
Joe Alejandro.
Patrick Hendry.
DEA. SBA. LBA. CEA. Commissioner of Finance.
Phil Dukes for Commissioner Jacques Giha.
The Mayor.
Shuman Ray for Mayor Bill de Blasio.
Comptroller.
John Dorsett, designee for Control Scott Stringer.
And the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Next, let's do Teachers Retirement System. Patricia Riley.
John Adler.
John Adler is here.
Thomas Brown.
Here.
David Gudzansky. Lindsay Oates. Deborah Penny.
Here.
Susanna Vickers.
Here.
We have a quorum.
Thank you, Patricia. And NYSER's Elizabeth Reyes.
Mayor's Office, John Adler.
John Adler is here.
Controller's Office, Scott Stringer, Susanna Vickers.
Here.
John Dorsa.
Here.
Public Advocate's Office, Letitia James. Borough President Manhattan, Aldrin Bonilla. Gail Brewer. Borough President Brooklyn, Tonya Conflo.
Here.
Borough President Bronx, Marika Scott McFadden. Martha
Camille Sabio here.
Borough President Queens, Melinda Katz.
Alan Swisher, here.
Borough President Staten Island, Isaac Gorodetsky.
Here.
International Brotherhood of Teamsters, Gregory Floyd.
Lawrence Bosley for Gregory Floyd.
Transport Workers Union, David Katzman.
Dave Katzman for Tony Otano.
Districts 37, Robin Roach, Raymond Santander, Oliver Gray, Henry Garrido. We have a quorum.
Thank you, Liz. And Daniel Miller for Board of Education Retirement System.
Good morning, John. We do
Good
not have
morning.
a quorum today. One of our trustees is here, present today. We'll vote on Wednesday.
Great, thanks. Okay, we have a few items of business in public session. First, let me just say that in terms of the schedule, no, I'll do the schedule later. Let me just say that there is no January sim, so we'll all miss you. We'll all miss each other. Yeah. So the next sim is scheduled for February 6th. Mark your calendars with a big bright star. Okay, and then we have several recognitions to make today. The first one is for the public advocate, Letitia James. This is the public advocate's last. This public advocate's last meeting with us. As I think everyone in the room is well aware, Ms. James has been elected by the voters of New York State to be our next Attorney General, and So I think we have some recognition for her, and Tish may have some words for us. So we have a proclamation that we, I know, let me just say my piece. We have a proclamation for Tish that we often make, typically make for outgoing NYSERS trustees. However, at Tish's request, we are not going to read it for the record. We're just going to insert it into the record. So with that, I'm going to call on the public advocate to make any comments she may care to make.
An honor and a privilege to serve with each of you on this board in these last 5 years. I want to thank my fellow NYSERS trustees and also the trustees of the teachers, police, fire, and the Board of Education Retirement System for all the work that you do on behalf of New Yorkers, for all of our police officers, our firefighters, our teachers, and other city workers who each and every day proudly represent the interest of New Yorkers. I also want to thank Melanie, the Executive Director of NYSERS, and Karen, the Deputy Executive Director. I also want to thank the staff of the Bureau of Asset Management, Alex Don Unye. John Adler, I want to thank you for your friendship and for your advice. And of course, I want to thank the Controller's Office and the Controller. I want to thank Susan Vickers. Thank you so much for your professionalism. And thank you for your smile. And John Dorso, thank you for your friendship as well. And lastly, I want to acknowledge 2 members of my team who've been instrumental in guiding my work here and who have contributed greatly to the NYSERS over the last 2 years. Larry Schimmel, and to Amir Khan as well. I want to thank them for their guidance. Something tells me that Larry will not be missed, but anyway. But it's okay. I'm taking him with me. And so over the last 5 years, I've been proud to work with both of my friends in labor and my fellow city trustees to protect our workers and to ensure that we're doing everything in our power to set them up for long-term stability and success. It's been a tremendous opportunity to shoulder with you your partnership and your expertise, and we have prudently and effectively led this system, and we've made some major accomplishments. We've taken important action to protect workers by removing funds from investments that are risky and subject to significant volatility and threaten human lives. And we've made great strides to increase diversity and representation, whether that be in private equity or increasing opportunities for WMBE. But what I am most moved by each and every day, and that is helping the thousands of workers we've been able to support as a result of all of their work that they've done following September 11th. All of those proud individuals who've risked their lives, and some who are suffering from health impacts. They struggle each and every day. We've made it a priority to improve the process and to seek relief for them, and to proudly congratulate them for all that the work that they have done, putting their lives before others and thinking about others before they thought about themselves on that tragic day. And for that, I'm really proud. That has been my greatest achievement here at NYSERS. And so I don't deserve the honor and privilege. It's all of those individuals who have made the transition and those who are suffering this morning that I applaud. And so I'm humbled and I'm honored to have played a role in that and all of the work that we have done here on NYSERS. And again, to those officers, to those firefighters, to all of those first responders, I salute them and I salute their work. And so as I make my transition to the next position, I'm going to think about them each and every day and continue to fight for them and use the law as a sword and as a shield and represent their interest here in New York. So thank you, members. May you continue to do great work, and I look forward to seeing you in my next venture. Thank you so much.
So, Tish, I just want to say thank you, and thank you to your team. For me, it's been a real pleasure working with you and working with Larry and Umair. You have been really a real model of what a NYSERS trustee should be. And I think all of us who have been on the NYSERS board with you recognize the tremendous commitment and passion that you and your team have brought to NYSERS and the members. We will miss that passion at NYSERS, but we look forward to benefiting from it as you take up the mantle of Attorney General. Personally, I just want to thank you for your friendship since before I became a NYSERS trustee, and look forward to continuing it in your next position.
Thank you.
Thank you. Okay. Does anybody else want to share words about public advocate before we continue? Okay.
Yes, very, very quickly. I would just like to say on behalf of Controller Scott Stringer and also for me personally, all of the best wishes, major thanks for your dedication and service and, for putting your team together to come to the NYSERS meeting. They've been nothing but dedicated and focused on carrying out your agenda and your priorities, and that's made us all a better board. And for me personally, it's made me work harder and and focus more on things that I knew Larry or Umair would bring up, and want more focus on. So I really appreciate you setting the tone for your team, for our board, for the entire city, and now for the entire state. So thank you very much for your dedication and service. And I don't know if this is a good segue.
I'll do the segue.
Okay.
Okay. Thank you, Tish. We're gonna.
Thank you very much.
So we have one other now former trustee among us this morning who is also moving on to another office, and that is Andrew Gennardis, who has ably represented Brooklyn Borough President here at the board, and has, I think, as everyone probably knows as well, has been elected to the state senate from what, District 22? District 22, I always forget that, from Bay Ridge, Brooklyn. And Andrew, we did recognize Andrew at the last regular NYSERS board meeting, but I think some folks have something to say here as well. Want to start, Susanna?
Again, on behalf of the controller, Scott Stringer, and also for me personally, I'm just very excited and happy and just thrilled that Andrew's going to be representing Brooklyn in the state senate. We need people like him who are smart and dedicated and who are always going to do the right thing and deliver for the people of our city. So thank you, Andrew, for your service to NYSERS. Thank you for being a friend on the board. Good luck to you. We will definitely miss you. And I would like to sort of try to employ a sports metaphor and let you and the Attorney General-elect know that we are retiring your NYSERS nameplates. They will never be used again. We would like to offer them to you. We have a little...
Can I put that on my license plate?
I think it'll get you nowhere.
Nowhere.
So please accept, on behalf of NYSERS and everyone here, there's going to be a letter and a cute little nameplate being conveyed to you. And thank you, thank you, thank you, and best of luck.
Thank you. Thank you.
And for those who don't know, let me just make one a reference to Andrew, which is that Andrew is becoming the chair of the Civil Service and Pensions Committee. And so I think there will be people around the table here who will have an interest in that. And I know Andrew will remember.
We already have him on speed dial. That's what he's already on speed dial.
Right. So, and the chair of the Civil Service and Pensions Committee only comes from District 22 in Bay Ridge. So, okay. Andrew, did you have anything you wanted to say?
Thank you. This has been the opportunity of a lifetime. Those of you that I've worked with know how much I've just loved working on this board and with you all. And I've learned so much in the last 5 years from being around you all. The thoughtfulness and dedication and passion that everyone here, not just on the NYSERS board, but across all the 5 systems, really brings to the table has really helped shape and inform my experiences. And it won't be lost on me. And I hope that I can take all of the energy that's in this room with me as I go up to Albany and assume my new responsibilities. And don't worry, you will be hearing from me and seeing me in all in a positive way. But thank you very much to each and every one of you.
Okay, with that, I just want to acknowledge trustees who have come in since we did the roll call. You want to just introduce yourself, Aldrin?
Aldrin Bonilla, designee for Manhattan Borough President Gail A. Brewer.
And John? Yeah, we couldn't hear you. Turn the thing on.
John Kelly from the UFA.
Great. Anybody else? Okay. Great. We're going to move on. And before I hand it over to Mr. Donier, just acknowledgement that Alex Donier has had the interim removed from his name, so he is now our Chief Investment Officer, period, thanks to the Controller's appointment. So let's just give a round of applause to our new Chief Investment Officer. Okay, and just one more note. Please say your names when you speak so that Annette knows who you are, since it's hard to see around the table. Okay. Alex, the floor is yours. Thank you.
Well, thank you, John, and good morning, and welcome to the last SIM of 2018. I hope you're all excited about that. But I first actually wanted to start off by also personally and on behalf of BAM congratulating the public advocate Letitia James for her appointment. That is election. My definitely please correct that. My apologies for her election. I think that is just an incredible achievement. Honestly, as a New Yorker, I am proud that you will be representing us as the AG with your team, and look forward to all the great work that you and your team will deliver on behalf of all of us. And over the last almost 7 years that I've been here with the Bureau of Asset Management, it's been a pleasure working with you and your team. I actually will miss Larry. Larry, for many years, peppered me, and more than that, with very tough questions on what we were doing across the plan, but in PE in particular, where I have spent most of my time to date. So we will miss you, Larry. And it's been great, Umair, getting to know you as well. So we wish you the best of luck in your new endeavors and in your new role and position. Thank you. And also to Andrew. I think he moved. Ready to go. Andrew, yes. Someone also who I've gotten to know over the last years that I've been here. Certainly excited for your move and election to the State Senate. So congratulations on that, and best of luck to you.
Thank you.
So I just wanted to say a couple of words, and then we'll get started here. It's not lost upon me the role and responsibility that the comptroller has bestowed upon me to be the CIO for the Bureau of Asset Management. I'm actually humbled and honored to be serving in that capacity and to assisting and advising all of the pension funds of the City of New York and your beneficiaries. I'm actually looking forward during my time to not only partnering with the comptroller, but also with Mike Haddad, our Deputy CIO of Public Markets and Tradable Securities, Susanna Vickers, our Assistant Comptroller for Pensions, and all of BAM staff, which is here to deliver for our beneficiaries, maximize our returns, risk-adjusted returns for our beneficiaries, and meet our fiduciary obligations. In the near term, I wanted to share that what I plan to focus on is really engaging many of you and all of you, all the board trustees, on multiple fronts. I think one of the areas that I'm looking forward to just engaging your interest and what we do moving forward is going to be on updating our asset allocation study, and also, of course, discussing new investment initiatives. Those will include co-investments, which we began and launched this summer officially, and with the approval of the infrastructure co-investment platform. We will continue to engage all of you on incremental MWBE initiatives. FX hedging, as we've previewed you, is coming early in the new year. Climate change-oriented investment solutions are also areas that we'd like to engage the boards on. Certainly want to address budget and funding and corporate's budget, so that will be on the agenda in the first half of 2019, and certainly other topics of interest to all of you. For me, it's been a great and rewarding almost 7 years in the comptroller's office, and I'm looking forward to many more years working together and successful years for us together. So thank you. So with that, we'll turn it to this morning's agenda. As you know, in the public session, we'll begin with our performance reporting for the quarter ended September 30th of 2018. And we've actually organized our presentation this morning a little slightly different. And we've organized it into 3 sections. First of all, we will have Mike Haddad, who will present an overview of the public market returns for the quarter. He will preview a little bit of the fourth quarter, since there's been a lot of change since the end of the September quarter, as you all know and are experiencing. And Mike will also discuss the system's asset allocation and tilt in the portfolio. I will then walk through the third quarter of calendar year third quarter performance for the systems, and we will have Miles Draycott, who will present the risk report and review risk metrics for the quarter. So with that, we will turn it over to Mike Haddad for his presentation.
All right, let's just get on with it. So as Alex said, I'm going to talk about public market returns in the third quarter, and as usual, I'm going to do a little bit of a current market themes and forward themes, and then roll into that the asset allocation in each of your systems and the tactical tilts that are in your portfolios. So let's just start with public market returns for the third quarter. And if I had to pick a title for the third quarter, I would call it Continued Global Divergences. So what do I mean by that? We'll start with the returns in the third quarter and compare U.S. equities to international equities, and you can see the divergence in returns. A fantastic quarter for U.S. equities, while international developed markets were barely up and emerging markets were actually down on the quarter. And furthermore, I'd just like to call your attention to the 4 different time frames we have on this slide. So third quarter, fiscal year that ended June 30, and also 3- and 5-year annualized returns, and compare those to the last column, which are expected returns. And what that column is the expected returns, the average expected returns by your consultants when we did the last asset allocation. And what stands out to me is the outperformance of the U.S. equity market vis-a-vis its expectations, and also the underperformance of international and developed and emerging markets. So I think this has caught most by surprise, and that's going to be a lot of the theme of what we talk about today. Lastly, for third quarter, I'm going to mention fixed income. So the quarter was characterized by up in yields and tightening spreads, and you can see that in returns where Treasury returns were negative and credit returns were actually positive. And I'm not going to flip the page without reminding everyone that this was virtually the high in the equity market. So a lot has changed to September 30th. So continue on the global divergences. This is just a graph of what I displayed to you. So the 3 lines, the white line is the S&P, the Russell 3000, the yellow line is developed markets, the EFI, the blue line is emerging markets, and you can see where the divergences started in the spring. And it's not unusual to have divergent returns, but it is unusual for one equity market to go up and the other 2 to actually go down. And the returns in the third quarter for the international equities, actually you can see the last month was a very strong rally to get them back to where they were, almost unchanged. So continuing the theme of divergences, this slide shows a handful of metrics which highlights the divergences. So I talked about equity returns from a index perspective. When you go through the different countries, you see even greater divergences, with China being down on the quarter, the UK being down with all the Brexit issues, and Japan surprisingly having a very strong equity return. Further divergences in GDP. The U.S. experienced its second consecutive 3.5% quarter. While China, the 6.5% rate looks good on paper, it's a deceleration from their rate from the previous quarters in the previous years. And Germany and Japan actually had negative quarters, which is unusual. There's a story associated with both of them. Germany was going through some change in auto emissions, so they had a dramatically slower auto production, while Japan suffered through some natural disasters, specifically the earthquakes. Where there wasn't divergence was in long-term yields. They moved up across the globe. The metrics are there on the graph, and it's an impressive array of different countries who all moved higher in yields. And we'll get to more of that later. And then you can see in the last part of the slide where the differences in 10-year yields, and those differences have been in place for a while, and that gap continues. So that's part of the divergence story. One last slide on divergence, and that's divergent move in the dollar. So the top part of this slide shows the developed market, dollar versus developed market currencies, and against an index it was stronger. But when you look at its component parts, you can see quite a different movement of the dollar, specifically weaker against the pound and weaker against Canada and Australia. And the bottom part of the slide is emerging market currencies, and again, wildly different returns. While the dollar was stronger against overall the index, you can see the different returns depending on which currency it was. With the Turkish lira really having a rough quarter. In just 2 seconds on Turkey, it has some very fundamental issues in its economy, big current account deficit, and a lot of dollar debt outstanding. And then on top of that, the spats between the U.S. and Turkey have kind of accelerated to that. So before I get into the more interesting quarter, let me pause here for any questions or comments on Q3.
Any questions for Mike about the third quarter? We don't care about this. No, I shouldn't say that in public. We're interested in the fourth quarter. Let me put it that way.
So much has changed. So the slide on the left is global equity markets, and the orientation here is on the calendar year, not the fiscal year, so bear through that. The first column in equity markets shows you the returns in the calendar year, with the U.S. being very strong and international being down. And then the second column under equity markets is the returns through, I think that's last Tuesday, and they're probably 1.5% lower in U.S. As of this morning. So you can see the dramatic change in the equity market returns. And despite the divergence I talked about, it wasn't just the U.S. that went down. It was everything went down. The second thing that changed has been the rise in interest rates. So you can see the rise in rates on the right-hand side that happened through September 30th, and then what's changed since then. So rates have stopped their ascent. They're slightly lower. And that, I would argue, has more to do with the change in the equity market than the change in the fundamentals of the economy as of now. So what was behind this change in the equity market? So I'm going to talk about three things. I'm going to talk about global growth, rising interest rates, and then I just have a list of additional factors because I couldn't figure out what category to put them in. So U.S., we are definitely in some kind of slowdown, but I would argue not a recession. The last two quarters, Q2 and Q3, we grew at something like 3.5%. So we're slowing probably to something under 2. And what this graph shows, it's a JP Morgan graph, and it shows two different lines. And these lines are probabilities of recession. So the blue line is high-frequency economic data, and it toggles right around 21% in this graph. The orange line includes financial variables. So what's really driving this line is the flatness of the yield curve as well as the decline in the equity market. And it's right around 36%. So nothing more than just models that one of the investment banks use. So the takeaway is that the signs are up, pointing towards a more highly likelihood of recession. But you can see, even going back to where we were in 2016, these probabilities are still lower. So while the end of cycle term and recession is all over the financial press, I'm going to say 2019 is going to look more like a 2.5% year, where 2018 is probably going to be in excess of 3. In Europe is where the growth concerns are greater, and each country has its own idiosyncratic problems. You know, Italy with their fiscal standoff, UK's got Brexit, Germany has got their auto emissions issues as well as impact from the tariffs. They're actually the largest exporter of autos to Europe, to China, so that hurts them. And then France in the past month has had the yellow vest protests, and I think we should expect a negative GDP quarter in France. In Asia, the China concerns have lessened, but they're still there. China is definitely purposely trying to de-lever its economy, and it's showing up in the growth numbers and in their equity market as well. But they have a lot of different counteractions to do that with both monetary and fiscal stimulus. Japan remains in slow growth, but it's been that way for decades. So I think also affecting the equity market has been interest rates. And this really wasn't, this isn't anything new. It's been a slow drip over the past couple years. But the Fed meets on Wednesday. The markets expect a 25 basis point increase. This will be their 9th increase since early 15. Late 15, they went once in 15, once in 16, 3 times in 17, and 4 times. This will be the 4th rate hike. What's uncertain is how they're going to signal their intentions going forward. So you go back to their September meeting. At that point, they signaled that they expected to do 3 more hikes in 19, and the market is expecting that to come down significantly. And during this period of volatility in the last couple of months, the market has priced out one of the rate hikes into 19, and it's currently pricing just a little bit more than 1 rate increase. And you know I'm not going to mention quantitative tightening. That continues on. So that is going at $150 billion a quarter, which is the max amount. The Fed has slowly ramped this up quarter by quarter, and that continues to be a drag on financial markets. In Europe, the ECB last week confirmed their announcement that they're going to terminate QE at the end of the 4th quarter. So that adds to the whole global quantitative easing to global quantitative tightening, and that turned net negative in October, and that's going to remain a net negative going forward. And you expect, all things being equal, that's just going to be a negative for financial assets in and of itself. Bank of England, its rate path is very uncertain given the many different potential outcomes from Brexit. And in Japan, quantitative easing there continues to slow, and the Bank of Japan is slowly trying to engineer slightly higher rates and a slightly steeper yield curve, and that gets into what they term the reversal rate. And the reversal rate is a new word for the financial community, and it's a level of rates and a flatness of the curve that hurts the economy, doesn't help the economy. So the first central bank to address it, and I think we'll probably hear more of that in the future with central banks. So additional uncertainties. I listed a few of them up here. They're not new. So it's hard to really get your arms around what was the catalyst in October that started this. But these have been concerns of the markets for quite a while. They've impacted international markets more than U.S. Up until the 3rd quarter, and then in the last part of our markets of our presentation today, Miles is going to touch on some interesting stress tests for a few of these scenarios that will be good. So I'm going to talk a little bit about corporate leverage and GE. So with 0 interest rates and quantitative easing, one of the excesses in financial markets has been corporate leverage. It's the place where if there's systemic risk in the system, it's in leverage, and it's something like 65%. Pre-crisis, 65% of GDP was in corporate leverage. That number is now up to 75%. And GE has been in the headlines the past few months. And while its problems are idiosyncratic to GE, it does share a commonality with other highly levered borrowers. And that commonality is when something exogenous hits your company, hits your cash flows, and you're that levered, the spiral downward is very, very quick and very, very harsh. So in GE, they bought back almost 20% of their stock in 2016 and 2017, leaving their leverage ratios very high. And then in the different turnovers of the CEOs in the past year, they've taken some very significant write-downs on some assets, and that's put them into this very vulnerable position. And they're not alone in that period of vulnerability. And we're concerned about additional stress coming from the investment grade market. And then we'll talk about U.S. equities as well, because this is where I think you can attach a story to October. So what happened in October? It was Q3 earnings season, and the earnings that came out were in line with expectations, but the guidance going forward was not. So let me spend a little bit of time on that. So the concerns echoed by many companies were rising costs, increasing raw material costs, and concerns about trade. The whole tariff stuff. So the table on the left shows by year, and this is an S&P equivalence, earnings and then the growth rate. So what the equity market likes and what it rallies on is increasing earnings at an increasing pace. So think about the second derivative of that. And what you can see in 2018, it was a big increase in earnings and at an increasing pace. And the equity market really latched onto that, and that was a very big part of the rally in late 17 and into 18. But almost half of that came from the drop in tax rates. You know, as a reminder, tax rates for corporate America went from 35 to 21, and that is a one-time boost in earnings, and that's going to flow out of the year-over-year numbers. So when we think about 2019, the consensus earnings of 178, while that's still stronger, it's at a decelerating pace, and markets don't like to see deceleration in that component. And I'll add that with these earnings concerns, there's been the estimates for 2018 and 19 haven't come down, but if there's a risk to those numbers, it's on the downside. Which then brings us to the right side of the table, and this is across the horizontal axis, I have PE multiples, and on the vertical axis, the earnings summation, and it just gives you kind of a framework to think about where the S&P can go. So as a reminder, this morning it's trading right around 2,600. So if that would be the case on this table, it would be expected earnings of a multiple of 14 and a half-ish. And where is that in context to markets? And what does the PE multiple signify? I think about it as a psychology barometer for the market. The more optimistic the market is, the higher the PE multiple will be. The less optimistic, the lower the PE multiple. And 15 stands out because that's the trough of the multiple in the sell-off in 16, and now we're below that. So this is what the market's going to have to wrestle with. What's the correct multiple going forward, and what are the actual earnings? Q4 earnings season will kick off second week in January, so this will be a very telling time for the equity market. So how does all this translate into your portfolios? You've heard us talk about concerns about lower equities, higher interest rates, and wider credit spreads. So what we've let me just walk through what we're showing here just to make sure everyone gets it. So this is your asset allocation. The line across the middle is your strategic asset allocation. The gray bars are the size of the rebalancing ranges, and then the bubbles are it goes by system. It goes. You can see what the legend is on the right-hand side, and then. Take the first one, U.S. equity. So your portfolios are underweight anywhere from 2 to almost 4% U.S. equities relative to your strategic asset allocation. And again, these are as of September 30. The arrows are the general direction of our views on markets. So we have a bearish view on U.S. equities. We have a bearish view on high yield, a more optimistic view on international equities. But we haven't really expressed that in the tilt because we feel that the beta of that market to the U.S. market is too high, and that while they're cheaper fundamentally, until the U.S. stabilizes, they're probably not going to go up. So your portfolios are slightly underweight U.S. equities. High yield, we haven't expressed any kind of tilt in that, but we remain wary of that market. Before I leave that, one other thing. This is labeled your growth portfolio. So these are the assets that are mostly tied to GDP and earnings growth, and this makes up about 70% of your portfolios. In inflation protection, we have a slightly positive view towards bank loans, where it's slightly underweight, which is inconsistent with the view, but that has to do with some of the technicalities of placeholders for high yield. And when all those placeholders get unwound, bank loans will be back at policy weight. And then moving on to deflation protection portion of your portfolio. So both mortgages and credit, we've been underweight for a couple of years now. You can see we're near the bottom end of those bars where we're underweight. And then it begs the question, what are we overweight? If we're underweight all these things, what are we overweight? We're overweight treasuries. And how does that square with our view of rising rates? Well, where we're overweight is in the front end of the yield curve. So we're overweight the 2-year sector. And where that reflects itself is in the duration of your treasury portfolios. And as a reminder, the blue bar is where we're supposed to have gotten to with the duration extension plan, and we stopped about 50% of the way through. We put the brakes on that in mid-17. When you hear from Robert today on his annual fixed income plan, he's going to go into great detail as to why that happened. But when you add in the short duration securities that we bought, it actually shrinks the duration of your treasury portfolio as well. So that's where that lies. So let me pause there for any questions or comments on markets or your portfolios.
Questions for Mike?
Hi, Mike. Thank you for this presentation. I had a question on your slide 7 where you talked about probabilities for recession. I just made a note in my mind that was the last time when the asset allocation decisions were made. And it looks like the probabilities for recession are edging back up that way. Do you have any thoughts about that? And related to that, I also had a question around recessions. And, today the Wall Street Journal reported record buybacks for the year. And I just wanted to get your thoughts on that and what that might mean. And is that buoying the market or is that a signal for lack of investment opportunities for corporates?
So buybacks are running approximately $1 trillion for 2018, which is double the average pace of the last 3 years. It's a very positive for stock prices, but it adds risk to the companies. So while you reduce the number of shares, you're adding leverage to the company because most of these have been financed either by investment grade issuance or by repatriation of foreign earnings. And the repatriation is a one-time thing. The yields in investment grade have risen, so the economics of doing that have become more expensive. And lastly, to the GE point, it leaves a company very vulnerable. So while it helps in the short term, it makes them more risky in the long term. And I would expect 2019 buybacks to be significantly lower than 2018. One other thing in the FT this morning, and I didn't realize this, not a single junk bond has been issued in December of 2018. Because credit markets have widened, investors have changed their investment.
So that's a high yield market, you said?
High yield, but it speaks to credit. And the last month that happened was November of 2008, when there wasn't a single thing priced. Not making the comparison, it's just a fact that's out there. Okay. And as to recession, so the technical definition of recession is 2 negative quarters of GDP growth. It doesn't happen very frequently, and we're a long ways away from it. You think about the components of GDP, 2/3 of our economy is the consumer. The consumer is healthy. The unemployment rate's at 3.7. Labor income of the workers, it's number of jobs times hours worked times wages. Income is very healthy. The savings rate is low, so the consumer is not the one vulnerable as compared to 2008 when the dynamics were different. It's corporate America that's levered up. So if we do get a slowdown or we do get rising rates, that's the concern that will flow through the credit market, but then that flows through to the equity market too, because that's the vehicle that finances the stock buybacks. So that's how that kind of ties together. And as to a U.S. recession, we're long-term investors. We have diversification across regions, across asset classes, and it's something we have to drive through. To the extent we can limit our losses in a downtrade, we start with a higher base to go forward again. So that's what some of our tilts are about.
Thank you.
Any other questions for Mike? Dave Kazansky.
Dave Kazansky. Mike, so earlier this year, Powell was talking about us being far away from neutral. Now the talk is we're much closer to neutral than we thought. Is that, has something fundamental changed, or is it pressure from the president that's suddenly changed this outlook on where we are and how interest rates are going to go?
So I would say the first thing, I think he's learning the importance of his words. The first statement happened on an interview with PBS, and he muttered, he didn't mutter, he stated we're a long way from neutral. And we are a long way from neutral. Neutral is usually the real rate plus 100. Inflation's running around 2, so that's somewhere around 3, and the funds rate, is not near that. And then his second, whatever, and that was the beginning of October, and that was part of that sell-off as well that triggered that. And in the month of October, with the equity sell-off, we had higher rates. So, we didn't get, both went up, both went down in price. His most recent one, again, I think it shows the importance of his words. He said we're closer to the bottom end of neutral. And if you look at the Fed's forecasts of neutral, they range from 2.5 to 3.5. So again, it's just a statement of a fact. So I think the markets are perplexed over what he really means, and they're looking for clarity on Wednesday. And I think what we're likely to hear is data dependency. In reality, it's data dependency and financial market dependency. You heard me talk about financial conditions before, so that's the theory of financial conditions is it's not raising rates or lowering rates that matters, it's the transmission through financial markets which impact the economy in forward space. And they have tightened. They've tightened a lot with a drop in the equity market. And to me, that's what has him backtracking from the first part of his statement. And financial markets have moved that way as well, and that's what the drop in yields has been about.
Any other questions for Mike? Thank you, Mike.
Well, thank you, Mike. And with that as a backdrop, we go back to the third quarter. And we'll go through third quarter performance, if I find it. Here we go. So we begin here just with an overview of the system's AUM at September, and you can see the assets for each of the 5 systems for the quarter ended September 30th. And in the aggregate, we were above 200 billion, but certainly, as Mike mentioned, there is some downside to those numbers given kind of market performance in the ensuing, in the ensuing quarter, 2.5 months of the fourth quarter. So this is a snapshot of just performance for the September quarter. You will see kind of in the middle column labeled 3 months that the returns for the systems ranged anywhere from 2.56% for BRRRRs to 2.82% for NYSERS. You notice that the systems results, if you just follow the numbers down the bottom of that column, did lag the index portfolio for the column. So an index portfolio 65-35 was 3.35%. And that was primarily driven by the index having a greater weighting to the Russell 3000. And as Mike alluded to and mentioned, it was a very strong quarter for the U.S. markets. Actually, the Russell 3000 was up 7% in the quarter. In addition, the index has no exposure to emerging markets, and each of your portfolios has exposure to the emerging markets, and that market was down about 1% in the quarter. Lastly, the system fixed income returns trailed the index, given allocation to treasuries versus the components of treasuries versus the components of the Barclays Ag. Treasuries were actually negative. In the Barclays Ag, so that led to some weakness there as well, and that summarizes our results in comparison to the index portfolio. Now, if you turn to the 1-year and 3-year trailing, you'll see a couple of things. First of all, the systems continue to perform ahead of the assumed rate of return of 7%. If you look at the 3-year results, in addition to that, each of the systems surpassed the results of other large pension funds as measured by the Tux universe. And I'll just remind everyone that Tux reports their figures gross of fees versus what you see for each of your portfolios is net of fees. So let's look at the total portfolio returns versus your customized benchmark. So these are, again, on the far left-hand side, each system's returns. So you see the color designations, and then the middle is the benchmark. So it's each system's customized benchmark, and then you have the excess return, which in this case, in the far right-hand column, you see that there was negative excess return, or we lagged, the system's portfolio slightly lagged each customized benchmark. We've added to this page the horizontal line that you'll see. It's 171 basis points. That represents the actuarial rate of return for the quarter. So again, the systems have exceeded the actual rate of return for the quarter. However, as I mentioned, each system's returns for the quarter lagged the performance of the respective benchmark. And let's kind of get to the components of that. So when you break down the components that are contributing to that lag, you'll notice that it is primarily from asset allocation, which is the middle bars, versus manager underperformance or excess performance, in this case underperformance on the far right-hand side. As Mike reviewed in his asset allocation slides, the reason why we have some underperformance in asset allocation is due to the tilts that we've taken in the portfolio, and specifically, once again, the underweight to U.S. equities, which was a very strong performer in the third quarter of 2018. Now, you'll notice for BRRRRs, there is a little bit more of what I would say of negative manager effect in the quarter. I'll just mention that's primarily driven by your EFI portfolio, where BRRRRs has all active managers. There's one manager there, Bailey Gifford, which underperformed for BRRRRs in the quarter. So let's break down U.S. equities. First, we have total domestic equities. For the quarter, all systems performed close to benchmark. For teachers, your outperformance was driven by Brown, your manager Brown. For NYSERS, the slight underperformance that you see there is research affiliates. For police and fire, Iridian is responsible for a little bit of the underperformance there in the quarter. And for BRRRRs, some of the slight underperformance in the quarter is from Wellington. Turning now, to the components of U.S. equities. First of all, domestic small cap. You'll see that the big standout is teachers in terms of manager value add, and also police and fire. Now, this is primarily from Brown, which is delivering for you a concentrated portfolio, but also a lot of exposure to tech and healthcare, which were standouts in the quarter. What we can certainly anticipate, given the commentary from Mike, is that the fourth quarter likely will not be as strong for Brown for those same reasons, given tech, their tech exposure. But they were strong in the third quarter of the calendar year. For NYSERS, you see a little bit of underperformance there in small cap equities, and that is research affiliates and Wellington. And for BRRRRs, the slight beat there, you have some of your passive index accounts that are slightly beating their benchmark. Turning to domestic midcap, the systems have only two active midcap managers, Iridian and Wellington, and BRRRRs only has Wellington in domestic midcap, U.S. midcap. Wellington had slight underperformance in the quarter, but importantly, as you can see, significant outperformance from that same manager in the calendar year and in the 3-year period. Now, Iridian did underperform in all periods, and that was driven by poor sector selection and stock selection. Specifically, Iridian was underweight to IT. They were overweight to consumer discretionaries. They were also overweight to materials, which was the worst performing sector in the quarter. And their stock selection within these sectors hurt them as well. Now, turning to EFI, and you'll see here that BRRRRs had the toughest performance in the quarter, but certainly the best performance over the longer periods. Now, Bailey Gifford was the largest detractor to performance in the quarter for NYSERS and teachers. But NYSERS and teachers, I should say, benefited in the quarter from some of the limits that you imposed, those systems imposed on Bailey for the out-of-benchmark bets that Bailey can make in developed markets. Now, the out-of-benchmark bets that hurt Burrs Police and Fire with Bailey would have been primarily Chinese stocks. So think of Tencent, think of Alibaba. Those were tough performers in the quarter and led to the underperformance there for Burrs Police and Fire. It is important to note, though, since I'm mentioning Bailey a lot on this slide for the quarter, that Bailey has been a strong performer and has significantly outperformed, as you can see, in the calendar year and in the trailing 3-year period. Now, turning to emerging markets, you have police and fire, the outperformers in the quarter. That is driven by your manager, DFA. DFA has a value orientation, which is positive, and value performed ahead of growth. And China, they had an underweight. DFA had an underweight in China for the quarter, which also helped. For teachers, kind of the underperformance there, the lagging, the manager that underperformed in your portfolio in emerging markets was Lazard. Lazard made some bets in Turkey and Brazil, and you've heard Mike's comments with regards to Turkey and what's happening there. So that led to a tough quarter for Lazard in emerging markets. Now for NYSERS, also a slight underperformance in the third quarter. That is Parametric, was the largest detractor. They had exposure to IT and also Taiwan. Those led to some of the underperformance in the quarter for that manager. For the calendar year, though, Arcadian was responsible for some of the underperformance given their overweight during those time periods to IT and industrials. And for the 3-year period, Bailey Gifford will stand out as driving performance for police and fire, but they did underperform for teachers and NYSERS, Bailey. And for Burrs, Arcadian, which is your only active manager in emerging markets, drove the outperformance, for Burrs. Now turning to fixed income. Now, for the quarter, treasuries, mortgages, and investment-grade credit managers kind of performed close to index, but the outperformance that you see here was really driven by our decision to stop extending the duration program. As John chuckles. Later this morning, as Mike Haddad mentioned, Robert Fang, our head of fixed income, will provide more details on our duration extension plan. For the calendar year to date, I'll just wanted to mention that our short duration position from the start of the year was additive to relative performance. High yield. Now the high yield program gained about 2.13% in the quarter. Now, although incumbent managers beat the index for the quarter, the program's overall performance was slightly below benchmark, which you see on the far right-hand side. And that's due to the transition-related cash drag. Let me explain what that means. So the high yield transition included terminating 3 managers, and we transitioned roughly 50% of the assets in kind to 4 managers. Now the balance of those assets, the other 50%, was sold to transition managers, was sold by transition managers, for cash to fund 4 new managers, and that created some friction, negative friction here because it was held in cash. And that led to some of the underperformance for the quarter. Now, for the calendar year to date, some of the lower quality credits, the CCCs in particular, continued to rally. So our defensive positioning in high yield led to underperformance, as you would expect. Now, turning to bank loans, the program overall gained about 2%, 1.99% to be exact, for the quarter. In the quarter, most managers performed as expected. Barings, which is Burrs' only bank loan manager, significantly outperformed due to strong credit selection. For the calendar year, and that's similar to the remarks I just made for high yield, lower quality loans continued to rally. So again, the defensive positioning of the program led to some slight underperformance for the calendar year in bank loans. ETIs. So ETI, interestingly enough, outperformed in the quarter, which is actually counterintuitive given the rising interest rates. The PPAR program actually has a longer duration than the benchmark, so you actually would expect some underperformance when interest rates rise. In addition, in mortgages, you would expect lower call rates in a lower rate environment. Now, what actually happened with the benchmark is that the benchmark actually experienced higher prepayments than your ETI portfolio in the third quarter. So that led to outperformance for the third quarter, which is, as I said, a little unexpected given the rise in rates. You can kind of see, if you look at the calendar year, more normal pattern of what you would expect in this current rising rate environment for ETIs. So turning to hedge funds. So for hedge funds for police and fire, first of all, the third quarter for all of the 4 hedge fund strategies that your portfolios are invested in were positive. So it was a positive quarter. However, our tactical trade, and just to remind police and fire, the tactical trade is where 1% of the U.S. equity portfolio was reallocated to 4 hedge fund managers. That dragged down overall returns. Specifically, of the 4 managers that received allocation in this tactical trade, 3 had negative returns, being AlphaQuest, Allen Howard, and Key Square. Now, if you look at hedge fund returns with less the tactical trade, without the impact of the tactical trade, it is important to note that the portfolio continues to significantly outperform in all the periods we show here for the quarter, the calendar year, and the 3-year period. Now moving on to private markets. So we begin here with the OFI portfolio. Now the program outperformed, I should say, the PME for the quarter. So it's above the public market equivalent, but slightly behind the benchmark, which is that line that you see, 300 basis points, the benchmark being the PME plus the 300 basis points illiquidity premium. And although the OFI returns are kind of mostly influenced by very idiosyncratic or company-specific events, the lower quality rally, so remember what I mentioned in high yield and bank loans, the lower quality credit rally that hurt us in high yield and bank loans actually helped in OFI. So from a total return perspective, we'll also share that 65% of the returns in OFI were coming from interest income, and the balance, the 35%, from asset appreciation. I think PE is next, and in private equity, as a reminder, OFI was, as of the third quarter of 18, the balance of the private equity portfolio reports on a lag, so this is now as of the second quarter of 2018. So in private equity, second quarter performance, we continue to experience improvement overall in the PE portfolio. However, the overall portfolio does continue to lag the PME benchmark, which is the Russell 3000 plus the 300 basis points illiquidity premium, as the legacy portfolio continues to be a drag on returns. Now let's dissect that a little bit, and you'll be certainly familiar with this slide that we've been presenting for over a year or so. And on the y-axis, as a reminder, we have a measure of the PME spread, or the percentage of outperformance or underperformance of the portfolio versus the public markets, in this case, the Russell 3000. Now, prior to 2011, which is aggregated on the far left-hand side, and us changing our underwriting strategies together with your private equity consultants, we had negative results versus the PME benchmark, with the exception of fire, which was slightly positive in the pre-2011 timeframe. Now, since 2011, the systems have consistently outperformed, that you can see in the subsequent vintages, and they are well ahead, for the most part, in almost all individual vintage of the benchmark, which is not only exceeding the public markets, but the 300 basis points illiquidity premium. And we continue to see strong performance quarter over quarter and year over year in the private equity portfolio.
Is this benchmark or just the spread? In other words, where you say that in 2012, TRS is at 5.1%. That is their total PME or versus the benchmark of PME plus?
That's a spread.
That's the
So
spread?
it's aware, yes.
The spread over 300?
The spread over 300 based on the cash flows of the, it's a PME methodology, right? So we're tracking cash flows of the portfolio and applying that to the benchmark.
Okay, benchmark.
Yes, that is correct.
Great. Okay, thanks.
I think we're heading on to real estate. And we first show you core real estate. So just to start off, you'll see differences and variances across the 5 systems in the performance of the core real estate portfolio. And that can be attributed to 3 primary things. There are 3 things that will drive this across the systems. And it's certainly pacing, so the amount of dollars that are being invested in the asset class, manager selection, and the commitment sizing to each of those managers, depending how those managers perform. Now, for teachers, NYSERS, police, and fire, I just want to remind you all that you began investing in core real estate in 2006 at the peak of the last cycle. NYSERS in particular had a 6% allocation to real estate at the time, but the other systems, the other 3 systems had a 3% allocation at the time. What that means that some of your underperformers that were invested during that time, NYSERS likely had a larger exposure to them, so it was a bigger negative than it would have been for some of the other systems given your allocation to the asset class at the time. BRRRR has benefited, as we know, from making its first core investment in 2010, so certainly your timing was great, beginning to invest in the asset class at the trough of the cycle and at the beginning of the market recovery. Now, it's important to note that there's been a lot of work by Yvonne Nelson and the team to improve the performance of the core portfolio, and we're seeing that the results of that paying off with improvements in the results of core real estate. Now, non-core. So across the systems, with the exception of BRRRR, what we see again is that some of the results were impacted negatively by some of the legacy investments in the portfolio. So they have been a drag on overall returns. That being said, you will see that teachers and NYSERS slightly positive during this time period, which is a since inception time period, and teachers and NYSERS have benefited, and their results have benefited from the strong returns that were generated by the Tishman joint venture. So that served to mitigate and counteract some negative returns from some of your legacy investments early in you investing in non-core real estate. BRRRR once again began investing in 2011 and has very strong results in non-core real estate. So let's break that down again, as we do for the private markets, and look at PME spread. Once again, we like to look at the pre-2011 and post-2011 period, as that was a period where the teams made a very definitive and conscious decision to change our underwriting strategy, and in conjunction with your real estate consultants. And once again, you see here that the portfolio has consistently, outperformed since the 2011 period. So again, as a benefit of the strong and robust underwriting that has taken place over the last 7 years plus. So infrastructure, last but certainly not least, first of all, the infrastructure portfolio as of the second quarter of 18 is about 41% funded. Performance continues to be incredibly strong across all systems, and as you can see here, the performance has not only exceeded both the PME benchmark but also the IPS benchmark, which, as a reminder, is CPI plus 400. Again, some of the minor differences that you'll see across systems are due to different allocations based on your different allocations per system, to the underlying funds based on your target allocations for the year. And for some, there's also some impacts of opt-outs. There were some opted out investments, which actually had some fairly strong performance in the portfolio. So again, we also look at infrastructure at PME spread by vintage year. Here we look at the mature vintage years for infrastructure, 2013 and 2014. And again, the systems are enjoying strong outperformance in the infra portfolio. And it's two basic things. You've had some really strong early realizations. I think they've been mentioned in some of the re-ups that you've seen come before the boards in the last few months. And those have been drivers of overall returns. But also your existing portfolio, meaning your unrealized portfolio, has also performed strongly. So you've seen some markup in those valuations, all leading to very strong overall portfolio performance, well in excess of the PME benchmark. So that is the overview for third quarter performance, second quarter for some of the private market asset classes. And any questions? And
Any
we also
questions
have the
for
teams
Alex
here.
about the performance report? Okay, no questions at all. You answered all of our questions.
Excellent. So next we'll turn it to Miles Draycott with the risk report and reviewing risk metrics for the quarter.
Hi. Most of you, I think, have heard from me before. Sorry, I'm a little taller. Anyway.
Thanks, Miles.
Anyway, most of you have heard from me before, but going forward, you'll hear from me a little bit more often as we want to make a short presentation from risk part of every upcoming quarterly sim. So today, it won't be a terribly long presentation. We've made a lot of progress loading alternative data into the MSCI risk application. Sorry, Susanna, thank you. All right. Oh, there we go. There we go. We've made a lot of progress loading alternative data into the MSCI risk application, but we're not yet ready to talk about a comprehensive risk report that kind of covers both public and private market assets. We expect to be able to go over a risk report, that type of comprehensive risk report in the March 19 sim, and at that point we're also, for the first time, going to talk about P&L attribution. So we want to be able to generate, we'll be able to generate a kind of a detailed P&L attribution report, a little bit more on what that means later.
P&L, yeah, you want to just...
Returns. Sorry, my background is different than...
You're so sorry you're a little tall, and sorry your background is whatever.
Well, I apologize. Sorry? Oh, sorry. My background is from working on a trading desk, and P&L is profit and loss. So change in value of the portfolio. Change in value of the portfolio is what I meant by P&L attribution. What caused the change in value? So that's kind of a backward look. Just as a matter of kind of a little bit of overview as to what we're trying to accomplish. We're trying to make the risk reporting that we come up with more responsive to the issues that Mike talks about. And we want to do that in two ways. We want to sort of, looking backwards, we want to be able to say, well, we think we understood the risk of the portfolio at the beginning of the period. We know what happened in the market. Given those exposures, did what happened make sense? Oh, sorry. In other words, did the risk report at the beginning of the period, given the changes in the market, explain what actually happened? So that's why what I term P&L attribution is important. It's a sort of a backward look. The other thing we want to be able to do is integrate on a forward-looking basis some of the stuff that Mike talks about. But both here in front of the trustees, but also at our internal investment committee meetings, where we want to make the risk reporting relevant. And the current limited blue box reports are just one slice, if you will. So anyway, we're going to be able to do, hopefully, P&L attribution reporting in March 19, and as I say, come up with a more comprehensive set of risk reports. So with that, So today, we're only going to be talking about the risk of the public markets portfolio, so public fixed income and public equities. And what we see here is the highest level. This is the total plan risk, assuming that the portfolio, the plan consisted only of public market fixed income, public market equities. And we're just going through this quickly. We see this on the box on the left. We see a number of statistics. The first one to draw your attention to is the total risk, which is the anticipated volatility of the portfolio. So that's 6.29%. And for those of you, so what that means is that 2/3 of the time we expect the return to be within a range defined by up 6.29, down 6.29, around the expected return on the portfolio. The interesting thing to note here, or an interesting thing to note here, is that the risk of the benchmark is fairly significantly higher than the risk of the actual portfolio. And that expectation is confirmed by the portfolio beta statistic. You see there it's 0.91. The implication of a beta of less than 1 is that you'd expect the volatility of the actual portfolio to be less than that of the benchmark. So that sort of confirms what you see in the two risk numbers. The other interesting statistic on this page is the active risk of the portfolio, which is 76 basis points. So not terribly high, reflecting the fact that quite a lot of our equity investments are essentially indexed. What we see over on the right-hand box, the upper box on the right-hand side, we have an arrow illuminating it, is we notice that the weights, the portfolio weights of public equity and public fixed income, and then we see the contribution to risk. The dots represent the weights, the bars represent the contribution to risk. And what we see here is that public equity is about 60% of the weight for public equity in this within the public markets only portfolio is 60%, yet it's contributing about 95% of the risk. When we look at the active risk, which is sort of described in the bottom right, we see that their relationship changes. We see that actually fixed income contributes basically about 36% of the active risk of the portfolio. So interestingly, and more on this in the first quarter of 19, currency actually contributes 10 or 11% of the active risk of the portfolio. So that's the result of investing in foreign equities on an unhedged basis. So here we're just looking at the public equity risk. Again, we've blown up a little box there on the left-hand side. We notice here, the thing we've circled is the active risk, 54 basis points. Over on the right, we have the arrow, which is kind of illuminating the fact that only about 26% of the active risk is coming from selection. That's likely due from the use of active management in emerging market and developed market non-US regimes. And on turning to public fixed income, we noticed that the active risk is much, much higher, 195 basis points. And there are two sort of explanations for this. Fixed income as an asset class has to depend more on active management. You can't simply buy the index, which you can in public equity space. You have to do the best to approximate the index. But second of all, it also reflects the fact, as Mike and Alex have alluded to, there are a number of significant tilts in the portfolio expressed either by the underlying managers or BAM, or in consultation with you, by BAM itself. So just in summary, a couple of observations. Ex ante, the volatility of the portfolio has come down over the quarter. I didn't have a slide on this, but the prior quarter, it was the ex ante vol of the portfolio was about 6.59%. It's currently, as we pointed out, about 6.29. Public market investment portfolios exhibit less risk currently than the policy benchmarks. Public equity is the major driver of overall volatility, and public fixed income exhibits relatively high tracking error, which is a result of two things, just the nature of the asset class and the current tilts embedded in the portfolio. Sorry. Now here, these are some canned stress tests that are part of the Blue Box reports. Basically, when we implement the MSCI risk system, we have a menu of historical events that we can refer to as stress tests. So what this is it's were history to repeat itself, given where the markets are today, where our portfolio, the asset allocation of the portfolio, these would be the changes in value of the portfolio, to use a term other than P&L. And the point of bringing this up is to really refer you to the boxes or to the bar charts on the lower right-hand side. And what you see here is that in all the adverse scenarios, the current portfolio performs rather better than the benchmark. In other words, it loses less. The portfolio returns here are the blue bars, and you can see that they're significantly shorter than the orange bars, which represents the expected performance of the benchmark portfolio. So I mentioned earlier that we want to do two things to try and make the risk reporting more responsive to some of the discussions that Mike precipitates. And we want to do that in two ways. One, this sort of a P&L attribution, but the other way that we want to do it is by looking at scenarios that are responsive to some of the issues that Mike describes. The other reason for looking at stress tests, frankly, is that if you compare the volatility calculated by the MSCI application, it strikes me at least as being pretty extraordinarily low, given all the uncertainty that, at least intuition suggests exists in the world today. So it kind of rounds out the picture of kind of what could happen, given that the volatility numbers that the MSCI calculates, the risk numbers, are based on observed correlations and volatilities over the last roughly 18 months. And for those of you that watch these things, volatility has been pretty extraordinarily low. So it may not adequately anticipate what could happen given all of the uncertainty in the world. So what we wanted to do here is look at a couple of different scenarios. We did this in conjunction with Mike and with MSCI themselves, who've written a couple of recent research pieces. And we wanted to look at three kind of concerns. One is the possibility of a trade war. The other is the possibility of an Italian debt crisis. And the third is what's termed a hard Brexit. Now, in order to capture the possible outcome of a trade war, we sort of supplied the model with some assumptions, and then it sort of propagates the impact of those assumptions throughout all the asset classes you're invested in. So in the case of the trade war, we started off with shocks to the Chinese equity market of 10.5%, the U.S. market about 13%, the Euro 10-year yield coming down 16 basis points, similar perturbation of the Japanese 10-year, and a decline in the 10-year U.S. yield of 23 basis points. And then finally, we also imagined that the CNY dollar exchange rate would drop by about 12%. In this scenario, we would expect the portfolio drawdown to be about 7.5%. And this is, in fact, roughly the scenario we've lived through over the last couple months. And that is, very, very approximately, at least the equity markets are off about 10%. You guys, we are not invested 100% in equity. So that, roughly syncs with actually the drawdown we saw over the last couple months. If we imagined a more severe trade war was a possibility, we could see a drawdown of as high as 12%. I want to, I have no way of assessing a probability of any of these scenarios coming. I just want to step back and make that point. And some of the assumptions that we've put into the model in order to come up with the impact of these scenarios are somewhat arbitrary, but we do think they're reasonable and worth worthy of considering as a possible outcome. Anyway, moving on to the Italian debt crisis. In this scenario, we fed another series of assumptions into the model. We considered the likely, the primary precipitant would be an increase in the Italian yield curve. We saw the we imagined the Italian 5-year could increase by 250 basis points. That would, in combination, in conjunction with that, we might see the Italian equity market trade off by 26%. European volatility, the volatility of the European equity markets jumped by 110%, and the euro-US dollar exchange rate declined by about 7%. In this scenario, we'd expect the portfolio drawdown to be about 14.5%. In the instance of a more severe Italian debt crisis, we could see a very significant drawdown of as high as almost 26%. And then the final scenario we considered was hard Brexit. I think personally this one's probably a little overdone, but that could precipitate a decline in portfolio value of about 15%. Anyway, we wanted to go through some of the negative scenarios that could unfold. Any questions?
What is the difference between the moderate and the severe in the Italian debt? You talked about 200 BPS increase in the yield curve on the moderate. What's the assumption differences between the two?
Sure. The Italian debt, the severe Italian debt crisis, we imagine the Italian 2-year would rise by about 800 basis points, and that cost of debt service would basically mean Italy's insolvent. They're gone financially. So that would suggest that the Italian equity market could trade off by about 60%. European vol would jump to like 190%. The euro-US dollar exchange rate would drop by something like 12%. Admittedly, these are, again, we went through it in conjunction with Mike and MSCI, who've written some research on this stuff, but they are arbitrary. We've specified them. And then, like I say, it's not the case that we're just saying if these things happen to these markets, this is the P&L. We're saying if these things happen to these markets, the implication for all the other markets you're invested in. So we're allowing the model to propagate these shocks to all of the markets that you're invested in. But admittedly, the assumptions are somewhat arbitrary.
Other questions for Miles? Yes, Dave Kaczynski.
So if one or more of these things happen simultaneously,
I don't have an answer for that one.
I would hope they're not cumulative, where they just add on top of each other, that some of it is overlap.
Yeah, I don't think you can add them up. But I can't tell you what again, this is somewhat arbitrary, but we think these are concerns.
Other questions for Miles? Okay. Thank you, Miles.
Okay.
Alex, is that end of the quarterly report? Okay.
Mr. Facilitator?
What's that, Joe?
Mr. Facilitator, I have a question.
Yes, sir.
In public,
Mr. Alejandro.
So, Alex, you had mentioned that we're going to look to do a couple of things early next year. One of those was on the corpus funding. I have not seen for some period of time what we're doing with corpus funding, positions paid, things of that matter. So if we could have something to look at early next year, January, to see what we're actually spending out on corpus funding, and of course, any expenses, anything of that nature paid out, that would be a good starting point to have a discussion. Okay?
We can do that.
Thank you.
Okay. Anything else for public session before we entertain motions to enter executive session? Okay. So we will entertain motions to go into executive session. Let's do it in reverse order. So starting at NYSERS, is there a motion to exit public session and enter executive session?
So moved.
Thank you, Mr. Katzman. Is there a second?
Second.
I couldn't tell. Oh, Mirtha? Ms.
Yes.
Camille Sabio, thank you. Any discussion? All in favor of the motion at NYSERS to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Let me just note for the record that Ms. Robin Roach from DC 37 is present. Okay, let's move to teachers. Is there a motion at teachers to enter executive session? Thank you, Mr. Brown. Is there a second? Second. Thank you, Ms. Penny. Any discussion? All in favor of the motion at teachers to enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. Next, police. Is there a motion to enter executive session?
Motion to go into executive session.
Thank you, Officer Alejandro. Is there a second?
Second.
Thank you, Mr. Dorsa. Any discussion? All in favor of the motion at police to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. And at fire, is there a motion to enter executive session? Thank you, Ms. Brown. Is there a second?
Second.
Thank you, Mr. Kelly. Any discussion? All in favor of the motion to enter executive session at fire, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Okay, so we are in executive session. Please turn the cameras off. And Jeff, you ready? We ready for the for the report out. Okay. All right. Camera on. All right. We're back in public session. Liz, could you please report out about executive session?
The board approved a private equity commitment, the details of which will be disclosed upon contracting. The board approved a real estate commitment, the details of which will be disclosed upon contracting. The board approved the fixed income annual implementation plan. The board approved the alternative credit annual implementation plan.
Great. Thank you so much, Liz. Okay, so now we're delighted to have MSCI here to do a presentation to us about emerging markets. And I'm going to ask Miles Draycott to do that introduction.
Emerging markets?
Isn't it?
It's ESG, sorry.
Well, ESG and emerging markets, right?
So MSCI has been a wonderful partner for us. They're the vendor that we feel like licensed the risk platform. They're also the primary business of theirs is also as an index provider.
I can't hear you, Miles.
Why don't you stand up, Miles?
Sorry, this is rehearsed development. So we license our risk system from MSCI, so we have multiple relationships with them. They're also an index provider, probably leading index providers. We've worked with them fairly extensively in terms of implementing our risk system. As you may know, when we procured the risk system, we also licensed a large set of their ESG data. There is one portion of their data that we don't license, but we have the ability under the contract to license it. That's the letter grades that they assign based on ESG criteria. But without any further ado, I know Dorsey and Amar, I'm going to run out of while we get to the names of the other people, so why don't I let
Yeah, sure, I can introduce everyone. So hello, thank you so much for having us today. Why don't I can introduce all of us and I'll say a few words and then pass it on to Paul and Laura for the meat of the conversation. So my name is Dorsey Barnett and I'm responsible for the coverage of asset owners and investment consultants. That's pension funds, foundations, endowments. And Paul Schitzman is in charge of asset owner relationships for the United States. Laura Nishikawa is one of our most senior research members within our ESG group. Amar Gauss is in charge of a consultant team that works with asset owners and consultants for our analytics business, and he's also the key account manager for New York City Comptroller, so he's the main relationship manager. And Greg Rule, who is consultant for the ESG research products with New York City. So given the feedback from the team at New York City, we put together a presentation that hopefully addresses some of the questions that you all have raised, and we have a formal presentation, but of course, please interrupt us at any time, and we welcome questions. We're thinking of presenting for about 20 minutes, and then leaving it open for questions, and we can address any sort of topic that you would like regarding this topic or anything else that I'm
well, let's make sure we have enough.
Great, so thank you very much, Dorsey, and thank you all for having us today. We're just passing around the presentation, and we can definitely be flexible and talk about any of the specific topics that are most pertinent. What we put together here today does focus on our ESG research services. And so when we talk about ESG, we're going to look at the three categories of services that are available to New York City comptrollers of Bureau of Asset Management. The first is one that you're very familiar with, which is just the mapping of business involvement to specific ESG activities. That could be something like tobacco, thermal coal, labor issues, ways that you can identify, map, and exclude anything in your divestment policy. The second piece of services is something that we call ESG controversies, as well as violations of global norms. This is more of a tracking service, keeping track of kind of any of the major controversies that come up for either public equities or fixed income securities. The third piece is what we call the ESG ratings. And ESG ratings is a more forward-looking metric that looks at the possibility for future risk associated with ESG issues, as well as that company's management's ability to respond and manage those ESG risks. And if you just think about kind of MSCI, as Miles mentioned, we work together with the pension system here in multiple areas, risk management tools, the benchmarks and indexes, as well as these ESG research services. And so for our ESG research business, we work with well over 1,000 clients. We have very broad coverage in both developed and emerging markets on a range of ESG issues and data. And we'll go into some of those details in terms of what's available. I think just to get us started, we'll just talk a little bit about just ESG investing, the current state of the market today. We'll then go into kind of a deeper description of what's available to you and the tools that we have to offer. And then finally, we'll just show how how the data, how the research can be incorporated into benchmarks and indexes. And so if maybe we just get started in the presentation. Hopefully there was enough for everyone. If you just look at slide 3, and thinking about kind of the current state of ESG, there's been a range of investors really growing in terms of adding an ESG layer into their investment process. And one of the major metrics we look at is how many asset owners, asset managers are signed up for the UN PRI. It's about 2,000 at this point, represents over $81 trillion in assets under management. I think one of the key areas to look at is what that exactly means for those investors and how they incorporate ESG. And so for MSCI, we work with many of those clients around the world and have seen kind of a lot of different implementation options and offer a lot of the services that can be used across the board. And if you just think about why ESG is happening today, just going to slide 4, one of the major aspects of this is just managing both reputational risk and investment risk. And there can be a lot of reasons for this, but on this slide we really just highlight that the market is tending to react very quickly to ESG incidents. And if you think back in comparison 30 years ago, something like the Exxon Valdez oil spill, there was very little impact on the stock price there. If you look at any one of these issues, whether it's Equifax or BP, Volkswagen, there was a really big market reaction to the ESG news that came out. And so for MSCI, we're trying to find any of the warning signals that you can use to better understand if a company is going to be exposed to one of these kind of major ESG incidents. And then just moving forward, another kind of big difference today, if you look on slide 5, is we've had data for a good amount of time now that we can look at empirically how ESG affects the long-term investment performance of securities. And so at MSCI, we have global data on our ESG ratings that goes back 10 years. And we can do a lot with that data to understand, okay, what are the performance impacts? Is a high ESG rated company a lower risk investment? We can look at all of these types of relationships, and we've done a lot of work either ourselves or provided out to other researchers and asset managers to really look at the relationships that exist between these kind of ESG risks and the performance of the security. If you just keep going on to slide 6, you also see more and more examples of particularly large pension funds and how they're establishing an ESG overlay or an ESG layer to their investment process. And so just down the street here, we've worked recently with the UN Joint Pension Fund on formalizing their ESG into their policy benchmarks. And so they have a global policy benchmark of developed and emerging markets. They now kind of formally take out tobacco and controversial weapons into that policy benchmark. Another client that we've worked with, California State Teachers, you can see here, making a large allocation or commitment to a low carbon investment through a passive strategy. And so there's a range of implementation options. We're just seeing more and more from larger institutional investors. And so finally, just on slide 7, I think this is one of the most important points that we want to get through today, which is there is just a much greater range of data available today. A firm like MSCI, we've developed the models to take in alternative data sets that really can be kind of sourced from many different sources, whether it's academic or government databases, as well as NGOs, and kind of bring that in and create really kind of thorough and really kind of informative scores on a broad range of securities. And so if you just look at kind of an indication of how this has impacted what's available in ESG, this is just looking at market cap coverage of something like a high yield index. Now we've got above 90% coverage on what you have in kind of your typical equities and fixed income, but even in a space like high yield, we're getting coverage up to 80% of kind of the market value. And so we've made really great strides, even just last 6 and 7 years, really expanding what's able to be covered by all of these kind of ESG data points and the modeling of risk that we do. Another point here is just that on the left-hand side, if you think about what goes into a rating, these aren't just kind of self-disclosed CSR reports or sustainability reports. We are sourcing this data from outside this kind of self-disclosure model and really putting in the research work to do so. So just with that as the backdrop, I think I'll let Laura get into some of the more details on what exactly is available to you and how that might be applied to emerging markets or other parts of your portfolio.
Okay. I'm also here to answer any questions you have, so if anything comes up, please let me know. As Paul mentioned, I'm going to talk about 3 concrete areas. Our business involvement screening research, which is something that you use already today. I can answer any questions around our process, how we go about that research, how it's being used beyond just screening. Our controversies and global norms research, and then our ESG ratings, everything in that order. But in terms of how we're seeing this be used, I think what we're seeing, and actually, Paul summarized a lot of the trends that we're seeing, but just a greater need to really understand what you own, both from a reputational perspective as well as from a risk management perspective. One of the reasons when I talk to companies, when I talk to investors about the proliferation of ESG really is that this increased transparency, this increased information in the market makes it harder to hide. It's harder for companies to hide if there's a major scandal. It's also harder for investors to really understand everything that they might be exposed to. So I'll start with the screening research. Maybe I'll just start with a little bit of a brief introduction of our team on slide 10. Our ESG has been a very fast-growing part of MSCI. It's actually the fastest-growing part of MSCI. I joined about 11 years ago through an acquisition of a boutique shop. So 10, 11 years ago, ESG was very niche, very not in the mainstream, and we've really seen that change. We are about 380 people dedicated to ESG right now at MSCI in total. A big part of that is the research team, and a big part of that research team is the team that I lead. Our team is global, so we're global both because we work with global clients. As Paul mentioned, we have about 1,000 clients working just on ESG with us. We work with most of the large asset managers, a lot of the pension funds in the US, but also in Europe and in Asia. But we're also global because we cover a global range of companies. So my team has offices in Beijing, in Tokyo, in Cape Town, covering multiple markets because we really have to be able to understand what's going on the ground in terms of being able to capture both local language sources, but also understand the context of the companies that we're analyzing. So starting with the screening research on slide 11, this just gives you kind of a very high-level overview of the screening data that we capture and that we provide to our clients, both in terms of implementing exclusions or screening policies, but also in terms of monitoring exposures. So there might be categories that you're not screening out today, but that are worth really monitoring to understanding what you're exposed to. So this ranges from business involvement screens, and just if you wanted to know what the color coding is, the red items are actually ones that you are using in some way or another. So business involvement would include activities like tobacco, more recently, private for-profit prisons, firearms, other types of controversial activities. And we have an extensive research process to both collect that data but also to estimate where it's not available. We have an extensive corporate communication process to make sure that we have a chance for companies to respond. And we do both an annual review of that data as well as an event-based review of that data to make sure it's accurate. All of those business involvement screens are extremely granular, so if you've ever looked at it, it seems very simple to say what is a tobacco company. Anyone can name the tobacco companies, but it's much more difficult to identify which companies are suppliers, major suppliers to the tobacco industry, distributors, licensors who own stakes in companies. So we go in a very granular way on each of these screens, but we also consolidate it into some type of standards. So we've written a lot of guides in the last few years on screening that really groups these into kind of a minimal, low, zero tolerance, minimal tolerance, moderate tolerance thresholds, really to understand, to provide options for investors that have a different risk tolerance or different tolerance to exposure fees.
Did you come up with these because your clients asked for these?
Yes. Yeah, and that's actually something really important. So we don't actually, in our ESG indexes, we've done a lot of consultations to understand what are the most commonly used screens. I would say those would be tobacco, controversial weapons, increasingly coal is getting up there. But this is really something that's done on the discretion of our clients. So it's entirely, it's not MSCI saying don't invest in tobacco, don't invest in this category, that. We're really providing the data, and it's entirely client-driven. What we have done, though, is because we work with such a broad range of global investors, is consolidating where there's some area for common standards, for example. So that's in our business involvement screening. Our global sanctions screening is very similar, and again, it's entirely driven by clients. It's entirely driven by regulatory mandates. I'm going to talk for a second about our controversies and global norms screening, though, because that's a little bit different. This business involvement is really about revenue thresholds, revenue exposure to these types of activities. It's quite factual. You start getting into a little bit more of a qualitative space when you're saying which companies have been in breach of global norms, which companies have been involved in severe or very severe controversies. So I'll walk you through a little bit of our methodology there. But I will note that at least from a risk monitoring perspective, these two really do go hand in hand. What is your exposure to controversial activities and what is your exposure to controversial companies? Can both be
For a second, just to be interested in hearing when we
Speak up, Miles.
When we helped Scott Evans rewrite the various divestment resolutions that have been put in place and understand the impact of them, it was in fact this business involvement data set that we relied on to do that. So some of these things in red are in fact data sets we used to analyze your divestment resolutions. Sorry.
And we've done a lot of research with our equity colleagues, our equity research colleagues also, just to understand what are the investment implications of excluding some of these factors, right? Some might have a very minimal impact, whereas others might be much broader. So it's really a question for you in terms of what exactly is your tolerance and what are you willing to be exposed to. But in terms of monitoring your exposure to these types of categories, it can also be very useful potentially to stave off calls for divestment, to understand that you do have a process in place to monitor these types of issues comprehensively across the board, even if you're not meeting those exclusions. But again, it's very client-driven. For controversies, what we do is quite different. We have a dedicated controversies research team. They're monitoring the news every day. We do use AI and machine learning, natural language processing to get the right cases from a very broad set of thousands of news sources. What adds value is in the classification of those controversies, rights controversies, labor rights controversies, and then the assessment of the severity. So we assess every controversy from minor, moderate, severe to very severe, so that you can have a comparable data set. Now, it's very rules-based in terms of we have a distinct methodology for each of these cases, what constitutes a severe controversy, what are the exacerbating factors that could increase the severity of that controversy, is there involvement of senior executives at the companies of a systematic pattern of this. But we've also mapped a lot of those categories to global norms, such as the United Nations Global Compact or the ILO labor standards. So it's very much used interchangeably with global norms type of screen. The scoring model is very, very simple. It just takes the worst of the controversies that a company has faced. So if the company faces a red controversy, the company carries a red flag. Red is the worst of the worst. It is really where we see there's a contravention of global norms. It's a very, very small percentage of companies that get a red flag. It's about 50 companies out of the 7,500 that we analyze. So it's really the most egregious violators of global norms, whether it's human rights or labor rights or environmental norms. Those red flags go through a very extensive committee process. I was just telling these guys today that we spent half of the morning in a committee. We have subcommittees for each of our research groups and then an overarching committee that has to approve any red flags. We give the company a chance to respond. We contact every company that we assess, every company that we rate on a systematic basis, and they have an opportunity to respond, but we don't wait for the response to publish the finding, because if you can imagine a company, would have a huge incentive never to respond to us again if they could delay the publication just by not responding. Orange flags are really those watch lists, so the severe controversies that are worth monitoring in terms of potential exposure to a red controversy. So a lot of our clients will use that as a watch list. What we cover, if you look on slide 13, the types of controversies we cover, this is just some examples of them, but we really organize them in terms of environmental controversies, human rights, labor rights, customer-related controversies, so that's actually where some of the Volkswagen or GM recalls might fall, as well as governance controversies, and that includes major instances of fraud or corruption. Any questions on the controversies research?
What are the data sources for that research? Like, how do you judge whether there's a controversy involved in the company? Just the news media or?
So we use a lot of news media. We use also a number of NGO sources. There's a really important piece of this, which is also screening for credible sources. So usually we require that there be some evidence provided or multiple sources indicating, especially for a severe controversy. The minor controversies are smaller ones. I think they're quite useful potentially in predicting a pattern of events that might lead up to something. So those don't go through quite exactly the screening that the severe controversies do, but they can be useful. So for example, and this is now about 10 years ago, but when the BP spill happened, there was a very documented case of smaller health and safety controversies that weren't necessarily addressed leading up to that. So some of our clients will use that pattern of events as a signal. But in terms of the severe controversies, we use primarily news sources. We have a number of local language sources in each of these markets. We have analysts covering all of the major languages. But we do look for credible sources. So if it's for example, an NGO that has an axe to grind against a company, we'll look for a backup source that is factual and that provides evidence. There's some very big controversies in the U.S. in the last few years to do with a lot of the pipelines, for example. That's something that we've covered very intensively. In those cases, before we added a red flag, which is really the highest threshold, we waited for the UN Special Rapporteur's comment because there was a discrepancy between what we were hearing from the company and what we were hearing from the news media, for example. And so having an extra source like the UN Special Rapporteur documenting the human rights violations was what it starts with.
And just one more question. So the coverage is 9,000 companies, and it's ACLI, IMI, so it includes all the emerging markets countries that are all the emerging markets companies that are in the ACLI index.
Exactly. So small, mid, and large cap emerging markets and developed markets. We cover a number of private companies also, and we also cover a number of frontier markets. So it covers the full emerging market universe. And particularly, I think a lot of this research, whether it's the the screening research, but probably more so the controversies research can be particularly useful in emerging markets, where you maybe lack certain information on the companies, where there's maybe a lower tolerance for these types of exposures. We see a lot of clients use both our controversies research and our ESG ratings research to get more comfortable or to set maybe higher tolerances in emerging markets. We've also seen from a performance perspective, and now we don't have as deep of a history in the emerging markets coverage that we have in developed markets. But if you look at the ESG indexes in developed markets versus the market cap indexes, or the ESG indexes in emerging markets versus the market cap indexes, we have seen a much stronger differentiation between based on ESG in emerging markets than in developed markets. So we've actually seen a significant risk reduction and outperformance in the past 5 years. That's not to say that it won't go on.
When you do longer form information, like long form journalism or books that are written by companies across the industry, how does that integrate?
So research that's integrated across an industry would typically be covered by our industry analysts. So I mentioned we have these screening research teams that are really specialized on their specific areas, whether it's tobacco research or weapons research. We have this controversies team that's really focused on the flow of news media. Now they might incorporate definitely some longer form journalism or investigative reports. Anything kind of from a book type format would probably add to that. Typically, when you see a very severe case or a severe case, there might be hundreds of articles that have been all kind of compiled to give that perspective. But we also have industry specialists in each of our markets covering each of the industries. They write industry reports that a lot of our clients use that are really looking at longer term issues and trends in those industries, and that's where we come into our research. But they also sit on the committees that approve the various factors, and we, for example, usually when we produce a new screen, it's because a client asks for it. We do quite a lot of thematic research on emerging topics. One topic we did a lot of research on last year was opioids and the opioid epidemic and how different companies were exposed to that. So that's something that wasn't necessarily in our model. The controversies were thought, but we saw a systematic pattern of something, and we wanted to give investors some intelligence in terms of how to dissect that issue. Any more questions on that?
What's your turnaround time to report your findings in terms of like your ratings?
So, it depends on what you're talking about. So we do have different turnaround times for different types of documents. We update controversies on at least a weekly basis, sometimes more quickly in the middle of the week if there's something happening. But we do take time to make the assessment. We have been asked, can you just push the news through? But I think everyone can access the news pretty quickly. So there is some turnaround in terms of making that assessment. But the time frame will really be smaller depending on how severe it is. So usually we try to react within a day or two if it's a severe controversy. It does get stuck in some of the committees because we do have kind of a governance process to make sure that we are accurate and in line with our methodology. One of the challenges with ESG is that because it is so dynamic and there are new issues coming up all the time, you have to have a flexible enough framework that you can capture those. Another thing that we've really seen change is the response of companies. And so a very, very typical use of our data is actually for engagement, not just for monitoring and risk management or making investment allocations, but also engaging with companies systematically. That increase in engagement by our clients has really affected us, and it's affected the response rate we get from companies. So right now, about 50% of our companies that we analyze, engage with us directly. But that's across developed and emerging markets. The countries where we have actually the highest response rate or the fastest growing response rate are the US, which took a little while. European companies have been on top of this for a long time. Japan, and that's primarily due to the allocations to ESG indexes by the Japanese pension funds. That's created a new kind of norm in the market, and companies are really seeking to figure out what it takes to be on these indexes and to become investable. So there's kind of a line in the sand drawn there. And then thirdly, in China, actually, we're seeing a response rate go from 0 to well over 50 in the last year or so, and that's really because of pressure by international investors.
rating 9,000 companies, where is the baseline, given that there's different levels of egregiousness across countries and regions? What is it in relation to U.S. companies related to U.S. companies, or is it amongst across the globe?
Yeah, so I'll get into, maybe if you go to slide 16, I can introduce the ESG ratings. So everything I've talked about today is really on a lot of the inputs are inputs that go into our ESG ratings. So the controversies are rated on just an absolute scale. It's just based on the nature of harm and the type of harm. So, what was the harm to people, to land, to, individuals or communities, and then how extensive was that? It's pretty much on an absolute kind of global scale. When we give companies an ESG rating, so our ESG ratings go from AAA to CCC, they're industry relative, first of all. We look at different factors in each industry. Governance is fairly universal, but the environmental and social risks of a utility versus a bank versus a pharma company are very different, so we take a very industry-specific methodology, and that's relative to global peers in emerging and developed markets. So we use ACWI, the All-Country World Index, as our benchmark. So the AAA, CCC would be relative within that universe. We do provide, rankings and percentiles and the underlying scores and components, though, that can be calibrated to looking within a market or within developed markets or within a smaller subset. The ESG rating, if the controversy is really based on reputational risk, on events that have happened in the past, how severe were those, did they recur, what was the involvement of senior management, the ESG ratings are really intended to be forward-looking. So we do take the controversies into account. It's a discount to the rating, but we're also looking at how exposed are they to these ESG risks based on their business model, based on where they operate, where their facilities are located, what types of businesses they do, and then how are they at managing that risk. So we look at both the qualitative disclosures from the companies, and the companies reporting on these issues has definitely been increasing kind of exponentially. But then we also look at alternative data sources, whether it's EPA data in the U.S. or other regulatory data, fines, and so forth, to calibrate that assessment. So it's a very data-driven, rules-based methodology. You have our industry experts who kind of really oversee the model for their industry, reality check the results. And then the AAA, CCC rating is based on that global period.
How frequently do you revisit a company?
So the revisiting a company is typically, we go through quite an extensive process when we initiate coverage, because that's when we're really collecting all the information from scratch. We do a 3-year look back on any controversies that we're involved in and so forth. And then we revisit it when needed, really, in terms of if there's a major event, if there's a new filing, if there's new information that's material, that could trigger looking at the company more frequently. But minimum within 1 year, we'll revisit the entire rating. Any other questions? So slide 17, not to get into too much of the nitty-gritty of the model, but it just gives you a sense of the types of issues that we're looking at. So on the environmental front, a very big focus has been climate change, but also exposure to environmental regulations. On the social side, we're looking at issues around human capital, labor rights, both in companies' own employees, but also in the supply chain, human capital, but also looking at product safety-related issues. So one of the issues that we've been looking at quite extensively in a lot of our industries for quite a while has been privacy and data security. So that's a good example of how companies, or how our model needs to evolve over time. So we do a pretty extensive annual consultation. We talk to a lot of the leading investors in the world. We just did 6 city roundtables with our kind of most engaged clients to engage them on potential changes to our model next year. So it's a very consultative process. And that includes bringing in emerging issues as they arise. So once a year, we do a full review of our model, make sure we're not missing anything. We go to the market for feedback, and we really implement that and change it. Governance is an area that we've been very, very focused on, and actually Greg comes from a company that we acquired in 2014 called GMI Ratings. It was a corporate governance specialist, so we've been investing very heavily into our governance research. For the last few years, we really think that governance is core to the ESG conversation. If you're fully governed, you can't be necessarily managing your environmental and social risks. I talked a bit about through our process. As I mentioned, it's kind of a spectrum. So you start with looking at what the controversial exposures are, what the controversial companies are, and then the ESG ratings give you a way to systematically identify outliers in the portfolio. So a lot of the ESG ratings are used by our clients really to look at potential downside risk in terms of those triple C or single B companies, whether there's a threshold placed on that or just additional due diligence or potentially engagement triggered by those outliers. Is really up to our clients, but we see a focus on the outliers. We also see clients using the underlying components, so the E score or the S score, the G score, to start to understand systematic exposures that they might not be aware of across the portfolio, to monitor those trends and changes. Are you taking an intentional bet on an issue like climate change or on water stress without realizing it when you're making your investment decisions?
I know you're not going to catch everything, but how do you do on the companies that have violations of ESG?
So back on slide, what is it, 4, I think? Let me see if I remember all of them. Equifax was an easy one. So Equifax is one where we added privacy and data security about a year and a half, 2 years before the breach. We had them flagged as a triple C rating, so the lowest in the industry, for weaknesses in privacy and data security relative to peers. So that was a pretty straightforward one. Valiant was a triple C rated company, had been for about 3 years. We flagged them on aggressive accounting and weaknesses in governance, potential early warning signs of fraud. We also flagged them for drug pricing related issues, which were core to our pharmaceutical model. TEPCO, we didn't predict the tsunami, so we did flag issues around nuclear waste management, but it was probably a middle of the road rating that was out of our control. And then Volkswagen was a really tricky one because that was one where you had falsified information, so the information we had to base our assessments on wasn't necessarily accurate on the environmental side. That's where it really, really is important to know what you're looking at and how you're looking at it through ESG. There's a lot of ESG talk now. There's a lot of different systems and different frameworks and different ratings. Volkswagen was kind of a darling in a lot of the European kind of systems of ESG. We had flagged them. They were the lowest of the European automakers. They were excluded from our ESG indexes. So it's not quite meeting the threshold, and it was primarily on governance concerns. So we flagged both for governance as well as aggressive accounting as kind of that combination. But on the environmental side, I have to say they were rated fairly well because the information just wasn't true.
I suggest you touch on two things, the relationship between the ratings and how you present,
Sure, we can do that.
And the other thing is just to mention business involvement. That's my recollection of it is it doesn't rely on the rating, you get to screen based on revenue. So in the case of looking at investments, the previous resolutions that prescribe, you actually prescribe, this is the thing, terminal fault. 20 or 50% of revenues that we're worried about. And that is since we didn't rely on ratings, we just rely on the information as the
Yeah, I think on that last point, the 3 signals can be complementary, but they don't always align. There are cases where they align. I was meeting with a Canadian pension fund the other day talking about some of the private prisons where there's a triple C, a human rights flag, they do align, but there's a lot of cases where they don't. The revenue screens really are exactly just that, revenue screens. The ESG ratings would say, are you the best managed or worst managed energy company from an ESG perspective, kind of regardless of that revenue screen. So they're very different signals that you can use in very different ways, but they can potentially complement each other if what you're trying to do is manage both the reputational risk and
the revenue data function kind of keeps you primarily,
primarily, but we do need to dissect. Sorry about that. We do need to dissect the information. So the revenue data comes wherever possible from 10Ps, 10Ks, but as you can imagine, companies don't disclose their segments in that granular of a way. Dual purpose nuclear, weapon delivery device. There's a lot of research that has to go into map that data.
No, it wasn't kind of trivial.
No.
It was less.
But it's less subjective. It's exactly. Whereas the ESG ratings and the controversies are giving an overlay in terms of an assessment. And so you have to understand where that comes from, but it can still be useful as a systematic way of identifying those outliers. But to the question of how those go into indexes, I'm gonna take that one.
Yeah, and so that's kind of in our last section. So if you look to maybe slide 22 is a good place to start. Obviously, Laura's team is just doing an extensive amount of work in modeling, collecting data, really kind of just a phenomenal job covering everything in emerging markets and developed everything within the ACWI index. So then the next question is, how do we take all of this data, incorporate it into a rules-based methodology, and put it into an index? And so if you just think about that on slide 22 and thinking about the kind of the three categories that we've talked about, you can apply this idea of just screening out companies based on revenue associated with some specific kind of ESG issue. You can look at controversy, so any company that's got a red flag and kind of any controversial activity. And then the third piece, you can look at the ratings of the companies within the universe. And the way we're seeing this applied, this can be something that's implemented at the policy level benchmark, something that can be set for setting passive exposures, or just setting an appropriate benchmark for an active mandate. And if you look at this kind of process, just starting all the way on the left, thinking about the ACWI index, so just a market cap index, very low turnover, very low cost, then putting it through each of these levels of what can be adjusted using all of this ESG data that's available. And so if you look at just kind of the first level is just screening out companies based on that business involvement mapping. This is something where it's kind of an off-the-shelf based on investor demand that we've seen from around the world. And typically what we see is something around tobacco, weapons. There's a kind of a UN Global Compact. There's a couple of really big issues that many investors gravitate towards. Then you look at kind of another option, which is very limited screening, but instead re-weighting companies within a benchmark. So a company with a higher ESG rating gets a higher weight, a lower ESG rating gets a lower weight. But essentially what that enables you to do is look a lot more like the parent level benchmark, not taking out a lot of companies from the universe, but really build a more positive ESG score to the universe. The next, I'd say, level that you can apply is actually screening out a larger set of companies. You can use this, essentially it's a selection methodology. So you only add in 50% of each sector within an index based on the highest ESG rated companies. So something where you're actually taking out a good portion of the universe and just using that to get a better exposure to your ESG ratings. You can do this another way, which is using the BARA optimizer. You give this tool a problem to solve. You say you want it to maximize ESG ratings, but keep a very low tracking error with the parent level benchmark, and it provides the weights and all of the underlying securities that you should have to build that index. And then finally, you can just do a more extreme version of this, where you take maybe just the top 25% of each sector based on the ESG ratings. So within this, you can use all of the tools that Laura really talked about. You can take out red flagged controversies. You can select specific activities that you want to be screened out, or you can use the ratings to kind of build this best-in-class model. I think that's everything we wanted to cover, so any questions?
There's a few more things that I find interesting. The first thing on the volunteers, from the point of view of the risk group, and generally, the fact that this data is all available through the BARA risk platform and can be used in tools like the optimizer is very powerful for us. That's just a remark. The second is that one of the reasons this is a topical issue right now is two of the larger pension systems had a China exclusion. Now, a long time ago, the data wasn't really available. We analyzed it. It's just a bit of oral history. I wasn't here at the time, but one of the concerns is child labor practices. So you might want to speak a little bit about how we analyze child practices, child labor practices. Chinese companies come up with perhaps an list of that as we just need to take.
I'm happy to talk a bit about that. So we have all three of the data sets I mentioned, the business involvement screening, the controversies research, as well as our ESG ratings are available in emerging markets, including China. one of the biggest projects we worked on this year was expanding that coverage to the China A-shares market, which was extremely challenging. These are companies that have never had an ESG rating produced on them before. There's a lot of challenges getting accurate data. There's also challenges with companies just by some of the dynamics of the market itself in terms of the governance structures, but also in terms of the business models of companies. You know, we saw a lot of volatility in terms of a company making, gardening equipment one day, packaged software the next way, and like operating ports. There's a lot of conglomerates, a lot of kind of tricky things. So we put a solid year and a half, dedicated a team to just that expansion of coverage. Our governance team did a very, very thorough job of understanding the different governance structures and risks, both from the state-owned enterprise perspective, but also variable interest entities and other types of structures. What exactly are the risks there and how can they be mitigated? We put out a China report on, if you want to see it, as well as did a lot of webinars. The controversies-based screening, of course, is quite challenging. You really have to get local language sources, and you also have to account for some of the biases in the news media, for example, in China. So we've had to go through a number of ways of, building relationships with other nonprofits to really get accurate assessments of companies, and that's partly why we built up this analyst team in Beijing. But it's definitely possible to screen out companies either based on their involvement in certain activities like child labor, or based on some controversies, or based on governance criteria, or some combination of the above, to become more comfortable. The ESG ratings were the most difficult because that's really taking all these different data sources. That was an extensive process in terms of understanding all the possible data sources for information. So, for example, there are very detailed municipal level databases of fines and violations on environmental issues, but also on social issues that aren't necessarily available to everyone. So we've had to really take our team on the ground to be able to consolidate some of that information. And we had to get companies comfortable also with the fact that they are going to be under more scrutiny now. So we actually did an event in Shanghai. We had 400 companies attend to understand the ESG rating process, what it means. When they start getting questions from investors, we've engaged with securities regulators just to get them all prepared. This is coming. There are ESG indexes now available on the China market. We see increasingly investors taking into account at least governance, but probably ESG considerations specifically in their emerging market allocations, just to mitigate some of that discomfort, whether it's on a reputational grounds or whether it's on more investment grounds. So that's an area that we've done a whole lot of research on, and we're seeing growing in terms of, I'm even thinking some of the Nordic investors I've worked with who've had less exposure to certain markets. This was really a precondition for them to start to build those markets.
And I'd just add, maybe if you look at slide 15, so if you think about the granularity that's available and really the precision that you can get to with this data set, not having to use a very blunt instrument, but you can actually select controversies by specific topics. So if you look at labor rights and supply chain, child labor, collective bargaining, and unions, I mean, you can really differentiate which issues are most important to you and your participants. The way we put this together in just the standard index is anything that has a flag over the last 3 years is excluded. And so that's I'd say kind of the starting point here. But there is a great level of precision that's available.
So let me just understand. So there's a company, and so let's just say we wanted to look at the issue, like Miles said, of child labor. So you look at this company, and does the company get, how does it work? Is that where you get a red, orange, or green, or is that where you get what do you get? So let's just, name some company, some fictional company. China Works. So how is, and we wanted to look at the company with regard to child labor. What would we see?
So on child labor, you would see, some type of an involvement flag, that there's evidence that there's involvement in child labor, but a lot of it would be based on the controversy. So there would be the red, yellow, green, orange, the severity, that would be linked to the specific cases or the evidence that we have to support that. That would be child labor not just by the company itself, but also in its supply chain. So that would give you that assessment.
And so the assessment, the sort of top line assessment would be a flag.
Yeah.
Got it. So then if we said, for example, that, you know, we want to take a closer look at anybody who had a red flag on child labor, boom, the set of companies would come up.
Absolutely, exactly.
But when you said before there were only 50 companies that were
Have a red flag
on anything or
on anything.
really?
I'm drawing a blank. There's a lot of mining companies that have had a lot of major fatalities. There are, Volkswagen actually has a red flag from a governance perspective because of the extent and nature of the fraud. There are some for labor practices, some for human rights violations, but really they're the most egregious examples. Orange flag is much more common, and that really would be considered your watch list. So for child labor, you could really screen out all the different levels, anything that's not green especially.
How much is there some bifurcation of a little bit of child labor, large child labor?
So the way the controversies are assessed is based on the nature of harm and the extent of harm. So our human capital and our people-related controversies, you know, the nature of harm could go from, you know, death and dismemberment to kind of mild inconvenience to everything kind of in between. So we look at the type of information. I think anything involving children would be on definitely the further end of that spectrum. So the scoring would be mostly based on the extent of involvement. So if it's a few allegations here and there, but no, you know, substantial evidence, we would still flag that, but probably at a much more minor assessment. But if there's repeated incidents, if it's indication that the practices are widespread in any way, that they're affecting, you know, multiple locations, or that it's something that's, you know, kind of, it really, that the extent of harm is very, very widespread or extremely widespread, that would be a much more severe controversy.
There's no attempt to estimate the percentage of revenues that are utilized.
Not with child labor. We did write a report on child labor, so we actually put out some analysis of what are also the industries, sectors, geographies that are most prone to child labor. We really used it as a tool to guide engagement. So we have a lot of clients that want to engage on this topic in particular. So we gave kind of a formula for how would you use our controversies data, and what have we found researching our own data to give you kind of a target list of companies to engage.
Okay.
I just want to, 50 out of the 9,000, right? So it sounds remarkably low. I must be reading probably my news diet must be like real diet because just for example, if we take indigenous peoples, indigenous land, and raw resource extraction, you know, there's just on that section alone, I can think of probably over 25, 30 companies, especially now with even China's expansion into Africa. Just in the last 6 months alone, I'm Kenya, Ghana, and South Africa. You know, so I just the number just strikes me. Unless, well, again, I don't know the different thresholds you're using, so it might just be an artifact of, you know, 3.2 versus a 3.5.
Yeah, so a red flag would be extremely widespread extent and extremely, you know, very egregious harm. And probably some exacerbating factors, including, you know, an executive cover-up or so forth. There are a few red flagged controversies involving indigenous peoples, for sure. There's, you know, some of the Latin American ones in the mining sector, Pasco Lima and others. There's also in the U.S. a red flag was, as I mentioned, at the Dakota Access Pipeline, really to do with the security forces violations in terms of violating human rights. But that's where that orange flag list comes in. So some of our clients, you know, don't really necessarily distinguish from a watch list perspective. The red and the orange list combined would capture probably most of the types of companies that you're thinking of. It's just that the red is the most extreme threshold where we find some global consensus to divest from those companies. Any large extractive company is actually, you know, typically quite controversial. So that's really just the worst of the worst. But we give the full spectrum from minor lawsuits to, you know, these, you know, widespread controversies, repeated security forces violations, and so forth. So So yeah, I mean, we're happy to share also some of the names and you actually have access to them. But between the red and the orange watch list, that's why we introduced this orange flag a couple years ago, just to give an indication of between those 50 and the other, 6,000, there's another, several hundred in that list.
And my second question, so this is it's cross-sectional, right?
Mm-hmm.
So it's not like time series. So it's not like there's examples of escalating to a red, and then some intervention happens or some engagement happens, and then there's a ascending to a green.
So that does happen. So we review, all these cases pan out over time. So we definitely see cases escalating from a yellow to an orange to a red. Some things start off as a red, there's some big surprise, but very often it'll escalate up. And then we review those controversies on a regular basis, either monthly, quarterly, or annually, depending on the severity, and potentially downgrade them. So there's typically a 3-year look back. We're looking at controversies in the last 3 years, but there can be a controversy that's quite old that just keeps recurring, that hasn't been closed, that continues to escalate, that can be around for much longer. But very often a red flag controversy after 3 years could get downgraded to a yellow or an orange. So we do look over time, and we give that full timeline also when we give it.
Now, I'm just trying to understand the relationship between the flags and these letter grades. So on page 16, you have the letter grades that are divided into green, orange, and red.
That's just a coincidence.
That's just a coincidence. Oh, that's confusing. Okay. So, in other words, you could have a red flag company that's not necessarily triple C.
Yeah.
And you could have a triple C that's not necessarily red flag.
Yeah, so very often the red flag companies have very low ESG ratings. But there could be reasons for that, because the controversy is just looking at the controversy. The red, yellow, green is just what happened in the past. This is also looking at what's happening going forward. So say management is turned over, they've put together the best-in-class anti-bribery systems, everything is working fine. They're still penalized, of course, because of the controversy in the past. It's evidence that they're not really up to snuff, but things are changing and there could be positives. So this is really a more holistic view. What you find much more often are triple Cs that aren't red flags. So about 9%, 10% of our universe is triple C. That doesn't mean they've had a major controversy in the past. It just means that they're highly exposed to these issues and have evidence that they're not managing them well. So those actually could be your watch list for future red flags. But they're different signals. If controversies is just what's happened in the past, the ratings are looking much more holistically at the company, how it's responded, its management, going forward, its governance practices.
What percentage of the universe is triple A?
It's sort of bell-shaped-ish, depending on, but in some markets, in China, for example, it's much more skewed to the lower end. But overall, globally, I'd say about 9-10%.
And does every industry have triple A?
Almost. Not every industry, exactly. For example, having a red flag precludes you from having the top ratings, having a poor governance score precludes you to certain criteria and thresholds you have to solve. Also, our AAAs and triple Cs have to be committee approved, and there has to be an additional justification. So there are some industries that don't have triple A.
So it's not strictly numerical or objective, this divided into rates. There's, as you say, there's a committee that has to approve the extreme ratings.
Yeah, so it's mostly kind of rules-based.
Mostly
rules-based. The committee has to approve any exceptions to those rules. So for example, say there's a real estate company that happens to own an airline, should we look at also those issues? So any exceptions to the rules are committee approved, and any of the extreme ratings or any major rating changes are committee approved. The case of truncations in the ratings or actually intervention by the committee are very, very small. So it's mostly just as a reality check to make sure that everything's calibrated. The idea is that two analysts should be able to research the same company and come to the same result. So it's very prescriptive of how they work it out.
Speak up a little bit louder.
I said I should know this. Can you send us the rules that you may already have?
Yes, I mean, we as I mentioned, it's getting a little confusing. We have the revenue screens, we have the controversy flags, and we have the issue ratings. Those are the three big buckets. We provide very detailed methodology documents behind all of those and also behind how they're implemented in our ESG indexes. So our ESG ratings methodology book is extremely comprehensive. But we also provide company reports on each of the three and industry reports that give you the entire rationale for any given name why it's classified as.
The only other remark I might make, and I just put this in the offer, first of all, I found it very compelling that how this information is available via the application. That's something that's put up on screen for everybody to just, the fact that it's so completely integrated with this document is quite compelling.
And, yeah, not only does it come with an application, but someone who could help you use it, which is Greg Rule here. So yeah, I'm glad to do that.
So I mean, we work very hands-on with most of our clients. Everyone has slightly different priorities when it comes to ESG, but we can definitely, that's why we have a consultant team as well. We're experienced in implementing this and what are you trying to get out of it and how can we be helpful? It's a changing world, it's a changing, I mean in general, but in ESG in particular, it's evolving very, very quickly, so we're very happy to help and lend a hand if we can.
So we would have the ability to essentially, we wouldn't have to just license an existing index from you. If we wanted to say, here's the issues/criteria that are important to us, we could determine those and then obtain, I think it sounds like from the platform, the set of companies that we wanted to potentially exclude, the set of companies we wanted to watch list, and then everybody else include something like that. And you know, you guys can help us, but we can more or less do that ourselves. I mean, when I say ourselves, you know, Dan. Not,
They have standard, you have some standard indexes.
Yeah, we create any sort of custom
indexes.
Characterizations of companies, criteria that you don't want.
We can create our own index based on the ratings.
Yeah, there's a number of ways, and because you have it in the analytics platforms, you can start to also gauge the impact of different decisions before, you know, going down any
Actually, that's an important point, because you know it's not as complex as some of the other issues, but on the screens that we get, full reference, nothing we like the screens. You know, because it was right in this platform, we specified what the revenue threshold was, and then you can say what the result of tracking error would be, which we can communicate.
Right.
And in particular with the screens, but also some of the issues like child labor, some of these topical issues, I mean, sometimes we have some clients who say, this is exactly what I want this 15% revenue threshold on this, and this factor, you know, we've written it down, we're done. Maybe you've done it through the risk systems, but we also offer screening guides where we give our opinion in terms of what we see most commonly used, what are some of the different trade-offs you have to make in terms of what might you be, you know, overlooking if you just take one approach. So we give a lot of guidance. There's reports probably back to 12, 15 screening guides now available. They're very short, couple pagers on primer to the issue and how it's being implemented across the market.
Any other questions for the MSCI? Great. Thanks very much for coming. Really illuminating presentation. Appreciate it.
Thank you.
So after they leave, I'd just like to have one quick little conversation on myself before we adjourn. We're in public, that's fine. Really just talk about next step. Okay, so can someone remind me who's on the emerging markets subcommittee?
Ray is.
Ray?
That's the screening?
Yeah, the screening. Emerging markets, yeah. So it's Ray, Aldrin, and
The control.
And the controls. Okay. Do we lose the whole control here? Hey, David? I just wanted to have a conversation about next steps. It's just-
So it's, that's what we is that
Say it again?
Is that gonna be part of the public?
Yeah, we can do it in public.
Okay.
Yeah, just, we have this committee, I think that you guys, I mean, this MSCI presentation is part of the process. The board doesn't meet again until February, so I just thought it would be useful during this meeting to discuss with the committee next steps, so we don't get, you know, way late as it were. Did Aldrin or, I'm sorry, it was Aldrin and Ray, who's not here. And
John Gorson, the
John
chairman.
Gorson.
Larry.
No, I don't think so, no. So, I don't know if you guys had any discussion in advance of this, but where do we go from here, is really the question.
Yeah, I don't recall having conversations prior to this
Okay.
in terms of where we go from here.
Any thoughts on, you know, where we wanna, what we think the next steps should be? There's other vendors out there, and I know, another vendor has been into, one of the other boards. John,
I
you
would
look
say
like you
that
wanna
there
say
are other
something.
vendors, but I think as Miles is a proponent of, you know, if we want to do something custom, we already have license to the MSCI system and certain of that data. If it were an evaluation of different, you know, existing ESG indexes, you know, then we might want to compare an existing, you know, a standard MSCI index against a FTSE Russell index or an S&P index.
Well, I hear that. I mean, it's not just about custom index, because part of the idea here, as I understand it, is, you know, I think we do want to maintain a portion of our emerging markets portfolio as indexed, but we also want to have some active managers, because I think there's a belief on BAM's part, and I think the trustees share it, that emerging markets is one part of the market where active management can add value. Is that an accurate statement?
And that's been our experience.
Right. So, I don't think it's simply the question of, I mean, presumably, we could agree on some, you know, existing index and then mandate our active managers stick within that index, but I don't really think that's what we want to do. I think it's more, what are the steps? Are we looking to use this data or some other data source and decide on what we think are the important criteria for judging whether companies, we want to bring companies in, watch list them, or take them out of the investable universe, right? Is that folks' recollection of sort of where we're heading here? Does that sound right, Alan?
Right, well,
And not by country is
right,
the
that
point,
was
it's by
the
company.
process that was in place by country, so
Right.
the idea was to look at other ways of doing it.
Yes.
Company level is one way, I guess. I don't know if there's even other ways out there or other firms that do it by countries.
I don't think we're looking at another way of doing it by countries. I think what we've said is we want to get away from the country screen because it's too much of a blunt instrument, and look at something that's more tailored to, you know, potentially exclude companies that don't meet our standards. I feel like someone or some group needs to kind of roll up their sleeves and dig in. We could do it on MSCI, and I don't object to that, but sort of to say, okay, what are the different possibilities here for criteria, and then what do we think makes sense, and then let's run some testing and see what it looks like, you know. And it could be that we just decide to use their ratings. You guys, is that what you said, Miles? Do we get their ratings or we don't?
We don't.
We would have to subscribe to that, right?
Correct, but when we actually negotiated with them, we got there's some sort of, Mike Garland had licensed the service from them, and we had licensed a portion of their ESG data, and Mike, there's some overlap between the two schools. This is too much detail.
Mike's getting the buck.
So Mike is gonna let go of what he's licensed, then he'll be able to get on the Barra One platform, because we have an unlimited number of licenses under that contract. And for another, I believe it's $75,000, we can pull all of the ESG ratings into that, onto the Barra One platform. So we negotiated a set price that we can go back to them and get the ratings. Another thing that's perhaps worth mentioning is, and I don't know exactly how this would work, we haven't talked about it, but there's some ability to make their ESG data available to the trustees consultants. I don't know if that means they can actually have it log on to our application, or how that works. We haven't built it, but we did ask that question. I don't know what it means. I don't know what the answer. We got a yes, but we're not quite sure what this means.
So is the decision before the trustees that a resolution in terms of moving, well, not for today's meeting, but in terms of we have to make a decision to move away from any country level screenings and deciding whether we want to do holding level screenings using Barra One or any other tool?
That's what we're looking into. So since we have this particular approach available to us, and since we can readily ask questions about it, right, one possibility would be to have the emerging market subcommittee sit down and say, well, what would a company-based screen, emerging market screen look like using the types of data they make available to us, right? Is it we exclude the double C's, the red flags, and construct a labor circuit breaker based upon the labor categories? Does that look right? Does that look right? And if that's sufficiently robust.
And I feel like what it would take is some one-on-ones to sort of dig in a little bit, working with the risk group at BAM.
So at the highest level, John, they didn't really come, it wasn't really that clear when they presented, which is why I tried to comment. There's kind of objectionable practices that they derive revenue from. And we identify, so that way that goes, we would trustees, not we, would identify those practices, and then revenue thresholds that are set somewhat arbitrarily, and you come up with a student company list, much like the rest of us previously passed. Or you can say, well, actually, we're not going to be quite that prescriptive. We're just going to rely on screens.
Right. So I feel like, so what I feel like is that we need to take a look at this. And in some ways, Miles, what I would recommend is that one or more members of the risk committee spend some time with you or your team or a member of your team to sort of understand what the options are, and maybe, model something like along the lines that Dave was talking about. Okay, what would it look like if we took all their red flags, and then, keep in mind that the red flags are about past controversies, and the ratings are forward-looking, take a look at what a labor circuit breaker might look like, put it together and say, okay, here's a universe, or here's 2 or 3 different universes, and, so we get a sense of what we're talking about. I mean, I don't think the board, honestly, in some ways, this is like you want to try, this is an approach to find a Goldilocks solution that's not too hot, not too cold, but just right. Right?
Yes.
The Goldilocks emerging markets policy. What do you think about that, Miles?
We're happy to work. However, I mean, I think it might be helpful if 1 or 2 of the trustees would like to get more familiar with the data available to, we should do a demo of the application and see what data is available, what screens are possible.
So unfortunately, I was going to suggest that be the emerging markets committee, but only.
Chair's not here.
What?
The emerging markets
Suzanne is not here, or John Dorse is not here, and Ray isn't here, it's just Aldrin. And well, so I mean, maybe what we could do is you know, I love giving John Dorsey assignments when he's not in the room.
That's even better.
I second that.
Except that in this case, there has to be at least one trustee go through the process.
That's not
who is
Pam.
not from the controller's office.
Right. So let me ask,
Labor, right? Citywide.
Well, the answer is, the answer is
Was that subtle?
very, very smart.
Was that subtle?
Very smart, Al.
I mean, look, we could also assign Ray, he's not in the room. The thing about Ray is he's, I know, very busy, not that anybody else at this table's not. Why don't we do this? Let's do it, let's not.
You know what, if Ray can't do it, I can do it.
Okay.
Except I can't guarantee anything after the February meetings.
What's the February meeting?
The February meetings of, our February meetings? Okay.
Nice.
Our contract deadline is May 15th.
Oh,
So I
right.
expect that at some point.
You're gonna be busy.
March, April, May, I'm gonna be kind of busy.
Oh, right, I understand. I mean, really, I'd love to get this moving in January.
So
Because,
like, January I can do.
okay, so why don't we do this? Why don't,
Maybe Ray can do it and I don't have to worry about it.
okay, so let's see if Ray can do it in January. Rob, will you reach out to Ray? And then, Ray can reach out to you, Miles, or to John, or John Dorsey. Yes. And figure it out, and ideally, there'd be some kind of report that could be made in February, either at the SIM or at the board meeting, whichever one is convenient. That make sense? Okay.
Would it be focused, at least primarily initially, on replacing the China country screens, so we'd be focused
Yeah,
on
it's
what
not
we-
just China, by the way, it's China, Russia, we have China, at the moment, it's China, Russia, Turkey, Pakistan, and Egypt. So yes, the idea is that screen remains in effect right now, but we, we're not actively updating it. Right. So, the idea is, our goal is to try to put something new in place in time to, for calendar year 2020. Okay? Okay? So, Jeff, did you get that? No. Okay.
I've been off since.
All right, so just to summarize, we're going to ask a labor member of the board, starting with DC 37, to work with BAM to look at the possibilities using the MSCI risk system that we have for different approaches to create a new emerging markets screen/watch list that would and do that. Try to do as much of that work as possible to look at options and possibilities during the month of January and make a report back to the board in February. Okay. All right. Anything else for today? Very good. A motion to adjourn would be in order.
So moved.
Thank you, Mr. Councilman. Is there a second?
Second.
Thank you, Mr. Bonilla. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Thank you, everybody.
Okay, during the executive session, the board discussed various investment matters, reviewed personnel decisions, and also made decisions about which candidates to hire. Now we need a motion to adjourn.
So moved. Second.
Any objections? Seeing none, motion carries. Have a great evening.